And any comments before we have our performance reviews?
No, Mr. Chairman. I'm going to let us move right into the Callan performance review for the MDC and ORP plan. Thank you, sir.
Great. Well, good morning, DC committee members. Great to see you all today. We're going to jump right into a review of the MDC. And I'd ask you to turn to page 18 of that book. Take a quick look at how the assets stood at the end of the second quarter. You'll notice from the table at the bottom, domestic equity holds over 55% of the total assets. Really there was a strong recovery in the second quarter, which continued to push those investments much higher, such that the total MDC closed June 30th with just shy of 2.5 billion in total assets. Now that is offset, as historically been the case, by an allocation to principal protected, the stable value investment for participants. Now, if we jump to page 19, immediately following, we can see how and break down the assets grew, how the plan fared over the quarter. If you go down that investment return column, you'll notice mostly black, indicating strong unrealized gains across the asset classes and investments, with the exception of REIT securities. Everything else was positive for the period. Net new investment that reflects money coming in and out of the plan was slightly negative of 23 million for the quarter. And that's really in line with historical norms. This program is typically cash outflowing quarter to quarter. Those two forces together are what drove the total plan value higher throughout the period. Now, if you look at page 20, I think from your seat as committee members, one way we evaluate the strength of the program is looking at the realized results. And, we really do want to take a long-term view, right? So I'll direct you to that 10-year column on the far right. And as you scan down the page, what you'll see is that virtually all of the investment options are in excess of their respective benchmarks and also rank pretty favorably against their peer groups, often above median and in some cases top quartile, top decile. Now, this is over a sufficiently long horizon, so it is not driven by a short-term market environment. From that lens, the investment options have been tremendously successful for the participants after fees. And speaking of fees, I'll ask if you jump to page 22 briefly. And another way that the participants in the MDC benefit from the oversight of the committee and the scale of the program is keeping costs very low. This is a great story that we like to highlight periodically throughout the year. But if you look at the bottom of the page in summary, the dollar-weighted investment cost of the MDC today is about 25 basis points. I can tell you that that's very low. And in fact, it compares to what you would have gotten in the market at the average cost incredibly favorably. It would have been several multiples higher potentially, given if participants had to go out and reconstruct these portfolios on their own. So from that lens, both from a performance perspective, a cost perspective, and then a design perspective, participants continue to allocate and utilize the plan as designed. Things look very good for the MDC. Any questions there before we take a look at the ORP?
So the percentage of our investment return for this quarter, was it extremely high?
The percentage of return.
Our rate of return on an investment for
Yeah.
this quarter. I know you gave it, but I missed it.
So for the MDC, the participant-directed plan, we don't have a combined total return, right? Because everyone's invested to their own accordance.
Huh?
Deferred comp. This is not PERS.
Okay, but
Yeah.
I'm wrong. My friend has corrected me, so I withdraw my question.
I would just say, Mr. Dale, that for the last quarter, all of the results, particularly equity, did deliver really, really strong results.
Good.
And there was a huge recovery in the equity markets that we'll talk about in the DB meeting. So the results did look very strong. Now, if we switch and open the ORP book, we'll jump right into page 2. And, as you know, the assets within the ORP are spread across 3 providers. The allocations have remained fairly consistent over time. Corbridge, Voya, and then TIA as really the biggest of the 3, garnering about 50% of assets. So that relationship and split doesn't seem to change year to year. But what we will highlight is how participants utilize the plans, the 3 platforms. And so on page 10, we get a first look at that with the Corbridge offerings. You'll see about 40% of assets in domestic equity, offset by about 20% assets in target maturity and 12 in stable value. So from an asset allocation perspective, the way participants are utilizing this investment menu is well balanced and they are well diversified in aggregate. Now we take a look at the second of the 3 platforms on page 27, being Voya, and we can start to see some of the differences. In this case, you'll notice a much greater preponderance of equity, right? So domestic equity in this case over 56%, most of that concentrated in large cap equity, and relative to Corbridge, a smaller amount in target maturity. Now, all that being said, participants are still very well diversified, balanced, and utilizing all of the investment options in the program, but there are just those differences in terms of how these participants have allocated themselves versus the Corbridge. And then we can see on 27 with TIA, it has gone a little bit in the other direction. So the domestic equity is down to 23%, about cut in half, a much greater usage of target maturity within this platform. So we do like to just highlight those differences. None is better than the other, right? Because from a high level perspective, from Cowen's view, the plans are being utilized as designed. Participants are well diversified. There's no concerning concentration of assets or lack of usage in any of the particular offerings. So the ORP continues to function as designed and is performing very well for participants as well, just like the MDC. But we'll stop there and happy to take any questions the committee may have.
Any questions on MDC or ORP? Thank you. About the watch list.
Thank you.
Thank you, Mr. Chairman. I am going to have Ryan Holiday come up and speak to us about the watch list.
Good morning.
Good morning.
I can turn your attention to page 2 on here. We only have one current member on the watch list, which is Loomis Sales. And you look at the trend, they're improving against their benchmark and their peer median. Unfortunately, we want to add T. Rowe Price International Growth Trust to the watch list. Their performance has just not been as good here lately. If you want to turn to page 3, you can see on their rolling 5-year and 3-year returns, they've trailed their benchmark, and their percentile rank is below 50, which is, we try to keep it above there. But as you can see, Loomis Sales for the 3-year period, they've got great returns beating their benchmark and their peer median, and hopefully we can get them off the watch list in the near future. But our one item today is just to add T. Rowe Price to the MDC watch list.
So no action on Loomis Sales. Is there a motion to add T. Rowe Price to the watch list?
There is a motion to add T. Rowe Price to the watch list for the deferred compensation plan.
So moved. Second.
All those in favor say aye.
Aye.
Any opposed? Motion carries.
Thank you.
Hey, deferred comp annual review.
Mr. Chairman, I am going to let Ms. Devetta Lee introduce our representatives here from Empower.
Great.
Good morning, Mr. Chairman.
Morning.
Morning.
Good morning, all. Familiar faces this morning from Empower. We have Ms. Mary Beth Dobbinspec, who is VP and services all government markets for Empower. We have Mr. Shannon Dice, who is Managing Director and the Direct Relationship Manager for our plan. He's been with them on this plan for many years now. And then also we have Mr. Rich Massengill, who is Director of Participant Engagement. In other words, he's over all the counselors and the outreach that happens here in Mississippi to our participants. So without further ado, I'd pass this on to Mary Beth. Thank you.
Thank you, and thank you for the time this morning. We're happy to be here and give our annual update. Actually, I think Shannon, you were going to start the
I
report.
will, and we're gonna walk you guys through the blue booklet here that we provided. I'm actually gonna start right behind the first tab on the introduction slide, where you see a reference to a benchmark. In this case, at the very bottom of that page, which is page 3, you'll see the number 42. So there are 42 plans that 41 plans that this plan is being benchmarked against. Those plans are on our record-keeping system in excess of $500 million. So on page 4, the plan ended fiscal year 2025 right at $2.5 billion. That number, in comparison to what the balance was just a few years ago in 2022, is up right at 25%. Participant balances ended fiscal year 2025 at 37,181, which is actually down about 3.8% compared to 2022 at the end of fiscal year 2022. There are a couple of things that impact that. Of course, the plan age is one of them. A second thing that we think impacts that is the third of the plan participants are terminated participants as well, so they can take their money out at any time. And then distributions, which was just alluded to during the calendar update, distributions continue to outpace enrollments into the program. Just for additional context, though, I thought I would share this with all of you to provide more color to that slide. Comparing fiscal year end 2024 to fiscal year end 2025, there were 2,080 accounts that existed at the end of 2024 that don't exist now in 2025. So the net difference of around 1,749 new accounts or new accounts that were added during the fiscal year. And there were some people that were transient as well. Rich will share the full new enrollment account with you here in a second. But we know about 190 or so accounts where people started during the fiscal year, maybe contributed a certain amount, but also terminated during the fiscal year and took their balance out of the program. Additional color, just FYI, of those that took full distributions from the plan, there were 300 of them that had high six-figure accounts. The average account balance for those individuals is a little over $301,000. And of that small subset of people, there were 15 of them whose account balance was actually greater than $1 million. And the average of those 15 was $1.5 million. Moving to slide 5, the next page. This reaffirms something that I just mentioned around the balances within the program. If you look at the left side of that slide, you'll see the average account balance has dramatically or demonstrably increased year over fiscal year. If you look at the end of fiscal year 2025, where the average account balance is $67,221, that versus 22 is actually an increase of almost 32%. Looking at the far right of that page, unlike say 10 years ago when I first started with this program, a preponderance of the balances of all accounts were in conservative options, fixed or bonds or something to that effect. The stable value or bond portfolio now has changed quite dramatically, where the majority of assets are actually in equities, and you can see how folks are choosing to use the program in the middle from an investment strategy perspective. Most people are still opting to do it for themselves, but a fair number of folks are using the target date strategy now, as well as the fee-for-service option or the managed account option. On page 6, all I really want you guys to do here is really just to look at the top line in the middle and the top line on the far right. This slide is all about account protection. It mentions account registration, but I would emphasize protection. We'll stand behind our security guarantee where if a person, if they're defrauded in some sort of way through no fault of their own, we will restore their account, 100%. It helps, though, if we get participants to register their accounts. So we have about 29% or so of the total population that have not registered their account. That's affirmed, if you will, by the number on the far right, where we have a fair number or a third of participants that have never logged into their accounts. So from a communication standpoint, it's a big focus area for us to, of course, follow up with those people to get them to register their accounts online. They don't have to. The security guarantee will still follow even if they don't, but it will help us out and, of course, help them out if they were to do so. I'm actually going to skip slide 7 and touch very briefly on slide, let's see, slide 9, actually. Just wanted to point out that in the last 12 months, there have been right at $71 million contributed to the plan. And if you skip over a couple of more pages to say slide, I'll go to the distribution slide. Okay. On slide 11, distributions, as I mentioned, continue to outpace contributions by a wide margin. Over the same 12-month period of fiscal year 2025, there was a little over $199 million that exited the program. I've generally have highlighted the type of distributions that have left, when I've done this presentation over the years. And what I'll highlight this year is that you guys, or the plan added a certain Secure Act distributions to the plan. Recently, one of them was the qualified birth and adoption distribution. And so where you see Secure Act at the top, sort of middle right, that represents the folks who took advantage of that option in the plan, which I think is great, by the way. So folks are using that for that purpose, qualified birth and adoption. If we go to page 13, this reaffirms something I mentioned earlier. You see the average account balance on the left compared to the benchmark. That's not a good or bad thing. Again, we're just showing you where the plan falls against the benchmark. But to reaffirm what I mentioned earlier, a third of the plan participants are terminated. If you look at their average account balance, though, the average account balance of that terminated population is 68.3% higher than the active population. So when one of those folks leave, it does have a significant impact on the overall asset level in the plan. And now if we could actually skip to pages 19. And actually I'm going to end my remarks here, and I'll hand it over to Rich. We just wanted to point out services that are actually active on the plan, and more specifically, I know there's been some talk around loans and maybe the addition of loans at some point in the future. We're agnostic to that, Devetta, but kidding, that's an inside joke. But one thing I did want to point out, though, is that the need for Roth contributions. So going into next year, what we'll do for folks who are, of age where they can take advantage of the catch-up contribution, they're not going to be able to. So we'll limit that to folks that are under 50. But when Roth is added, according to Secure Act 2.0, when Roth is added, of course, folks that make more than $145,000, they'll have to contribute on a Roth basis if they want to do the catch-up. But given that we do not or will not have Roth in place at that time, we will limit it to only folks who are under 50 where they could take advantage. Folks over 50 that are not making 145 can take advantage of the catch-up, but for those who are making greater than 145 cannot. So I wanted to make that point and highlight. So I'll hand it over to Rich now.
All right, I appreciate that, Shannon, and good morning. If we'll go ahead and jump to slide 22, and I'll kind of lead the way here with, we'll pop through a few slides, but when we think about participant engagement, again, I run the team of advisors across the state, and so some of the key components of their day-to-day is to meet with participants, have those one-on-one conversations, and a lot of times that's leading to conversations around how to invest in alignment with my goals. So we always like to look at the investment strategy. I know Shannon kind of talked about this a little bit, but we do think of these strategies from a do-it-yourself, a help-me-do-it or do-it-for-me type of approach. And when we start thinking about where our advisors can impact individuals the most, certainly is focusing in on those do-it-yourself investors, those that are not using any type of allocation or investment strategy, whether it's a target date fund, an online advice that they can build and have a rebalancer, or the My Total Retirement Program. So you'll see on this slide a breakdown of both the number of participants and assets across that. And again, nice to see where we are chipping away at that do-it-yourself strategy, right? When we think about a new enrollee into the plan, they're defaulted into a target date fund. So we know those new individuals, unless they override it, are getting an allocation tool. This is really impacting a lot of the older population within the plan, a lot of the terminated population, if they're either moving 100% into stable value or they're moving themselves out of target date funds and kind of spreading it across the accounts. If we jump to slide 24, when we think about probably the most engaged component within the plan is the My Total Retirement Program, right? So this is the program that individuals do sign up for. There's a fee for being in that advisory service, and it's a customized portfolio built around their goals. So we do track that to see, and this was added back in the plan in 2022, and so we're kind of seeing this organic move into that program more often, and certainly something that individuals are seeing when they log into the website, something our advisors are talking about if somebody does want to pay for an additional service on managing their assets in alignment with their goals. What I would call your attention to, that's something we haven't really talked about in the past, is if we go to slide 25, we have this concept of personalization. So as we do see utilization of the My Total Retirement Program, it becomes very important that we're engaging with those individuals on a regular basis, whether that's through the advisors in the field or through our call center, to update their profile information so that that program is actually evolving with them, and maybe as their goals change or their resources change, so on and so forth. So we do measure that as a key indicator for our advisors when they are meeting with folks that are in here. Did they go through the time to update their profile and make those adjustments? And then when we think about what defines a personalization, it's some of those additional inputs as well, right? When you think about the basis, you can kind of run some typical allocation or glide pathing based off of pretty simple age, time horizon, risk tolerance, that type of thing. But when we start incorporating true Social Security estimates, or even somebody who's collecting Social Security or PERS benefits, those types of things, adding those to that program create a much more personalized approach to where you can imagine two individuals are at 60, 62, they're going to have very different amounts of income, very different strategies, and that tool actually may invest one of them as a conservative, may invest another one as aggressive. So it's much more complex than maybe a target date fund approach. So we do want to keep an eye on those that are using that program. If they're paying a fee for that service, we got to be meeting with them and engaging with them so that we're always updating that profile information. If we'll jump ahead now to dig into a little bit more on the do-it-yourself investors, and then I will talk a little bit about our results from the field team. If you jump to slide 34, we take out and extrapolate just the do-it-yourself investors. We then start to think about them in kind of two buckets, if you will, right? We think of a high equity exposure individual where 75% of their account is exposed to equities, and then we also think of a low equity, or even in what we might call like an inflation risk, somebody who's very, very low of 10% or less in equities. So these two slides are really just breaking that down so that you can kind of see, when we look at your do-it-yourself investors, what side of the spectrum are they falling in. Not a surprise with this particular plan with some of the things we're talking about. When we look at those investors, they typically tend to be very conservative, right? So they tend to be stable value users. Not that that's wrong, but it's certainly worth having a conversation, even as they're through retirement or even nearing retirement. We'd like to see some level of equity exposure, and usually When we see somebody below 10%, they're usually 100% on the sideline. When we think about the do-it-yourself investors, this is a key component to our outreach. So if you think about our advisors, they're going out on site, they're doing group meetings, they're engaging at different benefit fairs, they're having one-on-ones, but they're also doing outreach to these individuals that fall in this category. We have access to that data. We also have what's called the Empower Communications Engine, which I'll talk about here in a few minutes. It's kind of connected to some of this as well, just to kind of create awareness and really drive individuals to engage with us or engage through the website or engage through the call center to review their accounts. So if we jump to slide 39, I'll just kind of go through our retirement plan advisor results for the fiscal year. So just shy of 3,500 meetings. When we think about the meetings that the advisors are conducting, we think of them in 3 different tiers: a group meeting, pretty straightforward; an individual meeting where it's typically just a service item of some type or a general education meeting; and then a retirement readiness review, which is that deep dive review of an individual's account, understanding their goals, their resources, and trying to provide them some recommendations. A new number in here that we haven't shared before is what's called the Best Interest Profile Tool, or underneath the retirement reviews you see BIP, right? This is essentially our advisors are required to use this tool when providing advice. So we think about the best interest standard that is out there. An advisor who talks with an individual who says, yes, I would like a recommendation on how I may invest within this account. Our advisors all use this tool. It creates an objective, consistent recommendation, so it's no longer that advisor's opinion on what they should do. And the tool allows an individual to respond to key questions along the lines of, do they want a dynamic or custom type of strategy? Are they willing to pay a fee for it, right? If somebody says, no, I don't want to pay a fee for anything, it'll take the option of my total retirement completely out of the equation, and may recommend a target date fund or a one-time online advice recommendation that's free of charge. So that tool is really critical to making sure that our advisors are providing that consistent advice out in the field, and that we're adhering to the best interest standard in those engagements when we do go and actually implement one of those investment changes on an account. If we go to the next slide, we'll see the outcome piece. So again, as we think about the effectiveness of the team, it's all about, are they driving outcomes? So it's important to be out there and meeting with individuals. That's one component. But when you are meeting with individuals, what's the measure of success? Certainly plan enrollments are a key component, usually getting those from group meetings, or I mentioned the individual meetings, the service type meetings, but also deferral increases or diversifications, rebalancing somebody's account into one of those investment strategies that I was talking about. Personalizations, meeting with those individuals in my total retirement program and updating their information, or helping with roll-ins and that type of thing. So you can see our results from an outcome standpoint. The next slide, I think, really brings it home as far as our advisors in the field being effective. 76% of the time when they meet with an individual one-on-one, they're actually implementing some type of outcome, right? They're encouraging individuals to save more or invest better, that type of thing. Next slide is just our Net Promoter Score. It's a 91. That is world class. It's essentially the scale for Net Promoter Score is -100 to +100. You can see some great feedback that we've pulled from our survey tool that you can read through. For insight, our Net Promoter Score last year was an 84. So this is just an improvement upon what participants in the plan are saying following a meeting with one of our advisors. And then the last slide I will end on will be the next one, which is the Empower Communication Engine, which I touched on earlier. So when you think about engaging with participants, communication awareness of the program is critical. So on the left, you see a traditional communications approach. We do that regularly, where we're actually sending out maybe monthly emails, or we're putting things on the website, those kind of traditional communication that you might think of. Separate from that, we're also have the Empower Communications Engine turned on, which is actually helping individuals based on information we know about them on their account. So if we actually go to the next slide, you'll see this getting started, saving, investing, and planning and optimizing. So when you think about this communication engine, these individuals may fall in one or two of these buckets, and that's the communication driving. Simple one might be something that we're missing a beneficiary. So when somebody logs in, front and center, when they log into the site, hey, make sure you update your beneficiary, it's important. Or if we haven't had a meeting with them, right? You haven't met with an advisor, you haven't spoken to us, give us a call. We'll have a meeting with you. They can actually book an appointment with an advisor right right from the email. So the communications piece here to create awareness and really drive engagement to our advisors through the website or to the call center is kind of critical to the entire participant engagement strategy. So I will pause there, or actually pivot over to Mary Beth to kind of wrap us up, and then I think we'll open for questions.
Great, thank you. I'm going to be looking at slides behind the Empower Update tab, and I thought I would just give a quick update on what we're seeing as far as industry trends that are impacting the DC sector. So the first is closing the coverage gap. Lots of conversations being had on how do we make sure that every American has access to savings vehicles to be able to prepare them for retirement. Significant focus this year, not only within our organization, but within the industry on AI. How do we make sure it's responsibly implemented, and how do we make sure that we get the most out of it to make life easier for the plan sponsors? Cybersecurity, that certainly goes hand in hand with all of our AI discussions. We are more than ever under attack from bad actors in the industry, and so our goal is to stay one step ahead of them and make sure we've got all of the industry standard protocols in place for security. So a big focus on cybersecurity. Data management goes hand in hand with that. We feel very strongly that that is one of the assets that you put in our care, and so that we make sure that as we are record keeping your data, that we're keeping it safe and that we're using it in a manner to provide insights on what kind of outcomes are happening with your participants to make sure that the program's working for you. There's been a tremendous focus on wellness and advice and marrying those things together. And so part of our offering has certainly been enhanced to bring more wellness tools to the table so that people are being provided with information from, let's call it cradle past retirement, right? We want to make sure they have all the tools they need in between there, and those are available on the website. And then we continue to see the market consolidate, the players in the market space becoming less, and this has been a trend that's been occurring for probably the last 2 decades. The next slide, really quickly, I'll just talk about where Empower is investing their money. A lot of work is being done to make sure that we make it easier for not only participants, but plan sponsors to do business with us. That would come in the form of enhanced reporting, additional security protocols, straight through processing. More investments in those wellness tools I just talked about. We're spending a lot of our investment in expanding our partnerships. So just did a partnership with an organization called Allegis for consumer-directed healthcare. We're finding that bringing the healthcare components, the HRAs, all of those functions together makes it easier for our plan sponsors. And then finally, of course, investing in our associates. That's a key strategic investment. I'm going to skip over really quickly to, slide 50 is what I believe it says. It says security enhancements. It's the last thing I'll cover today real quickly. We are, as I mentioned, we are an industry that is under quite the attention from bad actors trying to get into our systems. So we just recently made some really nice enhancements to the participant website with an additional multi-factor step, a capture step, where you just click that you're not a robot, but this prevents those people who are just doing AI to get into record keeping systems. So we're very excited about this latest enhancement. It gives more protection during registration. And with that, I will be done.
All right, any questions on that annual update?
The only thing I would add, it may not be as widespread, I've just had a handful, some people who think when they retire, they have to get out of deferred comp. And I've had, just in the last month or two, a couple who have come through and think they had to. And I don't know what we can do to make sure that they're, because by the time they have decided they have to, they've been inundated by 2 or 3 different outside advisors, and so I'm too late usually to pull them back in.
Yeah,
Or at least tell them that option is available for pulling them back in if they, should they want back in.
yeah, it's a very common problem across the industry. So there's a few things we're doing. The Empower Communications engine that Rich talked about, we have milestone campaigns that are targeting people from like 5 years before when we think they're going to be retiring to let them know they do not have to take their money out of the plan. As soon as we get a termination date on the record keeping system, we send out a communication that the headline on it is you don't have to take your money, right? And give them what their options are. A lot of people think if they need let's say they need $10,000 for something they're going to do, that they have to take their entire account balance. Trust me, there are people out there telling them that because they want them to move their whole account. So we do a lot of efforts. Rich's team, that's a common conversation they're having with people when they meet with them one-on-one. But we agree with you, that is a big issue, and we'll continue to focus on that as we move forward.
Senator Sparks.
Thank you, Mr. Chairman. The Roth contribution legislation, we will drop again this year. That's something that the board has recommended, I think, for 2 years. And we hopefully will get that across the finish line to help people understand those over 50 are just having an opportunity to catch up. But did I understand you to say that that would only impact people making over $145,000 a year, so anyone under 145 can still do catch up?
Yes.
Currently?
Yes.
Okay.
So if they're of age and making less than that, they can do catch up.
I want to make sure people are aware of that, because that's over 145 is probably a minority of our employees.
Yes.
But the other thing with that, it would also allow people who are eligible for to make a Roth contribution, because a lot of our employees
Yes.
are at an income level where it would be beneficial for them to contribute to a Roth versus a tax deferred. So it also open up an avenue for anybody that wants to make a Roth contribution. And I know if you come to our county, a big portion of our folks would be eligible for a Roth and probably be more beneficial than a deferred.
And I will add to that too, in the field, that's a common thing from our advisors when they're enrolling folks or helping folks kind of look at the plan or try contributions, is we get asked quite a bit around the Roth ability. And to your point, certainly the lower income earners, that tends to be very advantageous for them.
Well, that's kind of the way I've looked at it. It's what some people would call a no-brainer to pass it, which is probably why we can't figure it out in the legislature. So the concern or questions, I guess, the rest of these questions deal more with the fact that we've talked about deferred comp, which is optional. Going forward in Tier 5, there's going to be a defined contribution piece, which I believe y'all are going to be handling, which will be very similar to this. So some of these same concerns or questions that we have are much more important, because all new state employees will have a defined contribution piece. So I'm encouraged by the returns on the top tier. They actually exceed the PERS returns for our deferred comp people based on the data I'm looking at. And I do understand it would take a deep dive for those in the lower tier, because a lot of that may be people who are moving into fixed income because they're nearing retirement. They don't want the risk. And you've had a lot of discussion about people who self-invest without advice, if you will. I want to be very clear. They're not picking individual stocks, correct?
No, it's a fixed number of investment options, mutual funds or CITs that are in the plan. There is a self-directed brokerage option in the plan for those who want to do something a bit more sophisticated, I guess, on their own. But the plan itself is set with a fixed number of investment options.
Because that's one of the concerns, that I hear. I don't want our employees of the state to have to be savvy investors to be able to have success in the defined contribution piece. But you're going to have tools that are available to them of packages that have had wonderful performance over the years.
Correct. And what staff and leadership has decided to do is duplicate. So the investment options that are currently in the deferred comp plan would be the exact same investment options offered in the new 401A plan.
And then from the standpoint of trainings, you mentioned employee. Do you do employer training? That's an area of great focus for us. If we look at categories of employees who've not participated in deferred comp, we want to train their employers to help their employees, because they will reach out to you or respond to you, but they're much more likely to listen to peers, employers. So I would definitely, as we move into Tier 5, want to focus on employer training and things that we can do to help people understand what options that they have available to them. The high equity piece, at some point, people have a right to choose risk for return and understand that that risk also has a negative piece. But I feel I would be remiss if I didn't ask, and I'm not asking y'all to comment on a legal matter, but recent lawsuit, I think out of New Jersey, talking about driving people, the allegation, and I think there's 3 plaintiffs, it's not like we've got a class action here, asking about advice that leads people into high fee driven situations. Another thing I'd like for you to do, and maybe for the board's benefit, and mine at least, is to kind of help us, not maybe verbally today, but have an understanding of the fee structure. Because again, those employers need to understand, I don't want to discourage everyone, because if you have something that, click a box, this has a fee, well, a lot of people, economic actors, are going to say, I don't want to pay that fee, it cuts into my returns. But I do want to make sure that as we move into Tier 5 and we have people, you've got 15,000 or so participants, you're going to have 100 and some odd thousand participants, that we as legislators and this as a board are putting something out there that's understood, that they're paying fee for service. What does that get them to make sure that we're taking care of our employees? Thank you, Mr. Chairman.
Mr. Breland.
Good morning, everybody.
Morning.
Thanks for being here. Really appreciate the presentation as always. You may already have something like this, and if so, maybe just a site reference will work. But to the point of, I'm not sure the order is that somebody decides they're going to leave deferred comp, and then they happen to have some investment professionals over here waiting. I think it's probably the opposite. Because I've heard that before, where people say, oh, you don't want to be in deferred comp, just come on over here. Of course, they sell investments, right? It's their CPA, it's whoever. Is there something that compares the plans? Because there are differences. So there's IRAs are going to give you more options probably than you ever want, or deferred comp can kind of keep you with this, in the boundaries. Is there something that gives that for the fees, for instance, or investment options? It just does kind of a comparison, just juxtapositioning of those plans, maybe an IRA, or other common plans versus the 457. And you also got, contribution limits. So there's a lot of return to work. Well, under return to work, you're still working. Whatever rules those are, you can still, as far as I know, contribute to deferred comp, as long as you're not withdrawing it, right? So you're drawing your PERS benefit, and you're still able to contribute if you're under a covered plan or in contract with the state. You're still able to do that, which is an advantage none of them have, right? None of those other plans have that. I'm a school teacher, I come back to work. Well, now if my employer allows me to do it, which I would think most of them should, then they would be allowed to do that, even if they may not contribute to their retirement any longer because they're a retiree. Is there something like that that's already out there for comparison on y'all's website?
You want to take a comparison on?
You can go first.
Yes. So yes and yes to all of that. We tried several things over the years. And what we have in place now is a very simple document where we would encourage a member who's thinking about taking their money out of the plan. Of course, leave would stay in the plan, and here's why. But we start with the fee aspect. If they've already made up their mind, and to Mr. Benson's point, already been working with someone, maybe they have in their mind that they want to invest in something very specific, municipal bonds of some kind, which of course we don't offer into the plan, but it's a simple little list that we show what it means to be in a deferred comp plan and the fees associated with the deferred comp plan, which is $47.50 or 25 cents. I think it's $47.25 a year. And whereas on the retail side, if they were to go to an IRA, it could be as high as, 2 or more %. So we certainly lead with that. And then, of course, they continue to have access, whether they're active or terminated, they continue to have access to the retirement plan advisor team. So it's not as though they're out on their own once they leave employment with the state. So we tout that or position that as a benefit as well, and encourage them to stay for that reason too. And the last thing we would always say is that you're never compelled to take your money out. The only time you're mandatorily required to take money out is when you reach required minimum distribution age. And even then, you're just obligated to take that minimum out, and just every year, but the rest you can leave.
And
in
not
the
even then
account.
if you're working.
Not even then if you're working.
You're contributing to the plan, you can still
Yeah,
keep
if you're
working and not
active
even have to
and-
draw RMD.
Correct. So, but as soon as you terminate, that's when they'll start. But if you're at RMD age and still active, you can continue to contribute and you do not have to take it. So yeah, so there are efforts for sure around that. I will say too, to a question that was asked earlier, the fee structure is a per head fee, right? And it's the same fee that what is currently 4625. I think that's the number. Is the same for both the deferred comp plan, and will be for the soon to come 401A plan. So the fee structure is the same, the investments are the same. As it pertains to fees, the fee for service option that Rich mentioned, it's a flat 40 basis points regardless of the amount that you have. So there's not a tiered structure. And that was negotiated by leadership a couple of years ago. If you take that compared to what they may pay outside, say in a retail outfit, it too is significantly lower than say if they were working with an advisor where the fee could be say 1% or higher. So it's super competitive in that regard as well. And of course, all the individual investment options have operating expenses. That's sort of par for the course. But if you want to just know about the explicit fees, it's a flat per head fee at $46.25. And if they want to participate in the managed account program, the 40 basis points fee. And that's it. And by the way, at least for the program right now, the deferred comp program, the fee is actually waived for the first year. So for new participants, we don't charge anything for the first year.
I think going back to Mr. Breland's point, which is excellent in the sense of return to work, we want a cleaner return to work policy in the state, because under the prior tiers, people were retiring in their 40s or early 50s, and they still had to work. They needed insurance. They needed benefits. If we have a cleaner, more accessible return to work policy, then that's just a better opportunity for state employees to build wealth, because they do not cash out their deferred comp, and they can continue to not only let it grow, but contribute to it and stay an active member of the system through a return to work policy. Thank you.
Any other questions for Empower before we wrap up the annual review? And we actually have the hybrid plan next on the agenda. So any other questions? All right. You want to say a few words before we get started?
Yes, sir. Thank you, Mr. Chairman, and good morning again, everyone. We're pleased to have today to present to you the initial plan document for the DC side of the Tier 5 hybrid, drafted in accordance with the law for a 401A profit-sharing type plan. And as Ms. Lee makes her way to stay with a representative here from Empower, we also should have Ice Miller on the phone as well. For today, if you all approve the plan document as we recommended it, it'll be the initial adoption, and then we would come back in October for the final adoption. You probably noticed in reviewing it, it's very similar to the plan documents in ORP and MDC, other defined contribution programs that are administered by the board and the agency. In many ways, this is a legal document. It'll be submitted to the IRS. We don't anticipate hearing back prior to implementation, but just wanted to point that out, because in the future, similar to other aspects of PERS or PERS overall, we'll have employment guides, handouts, and things like that. But this is more of a legal document. As far as where we've come from or where we are right now, in the background on the document that you have before you, First, Ms. DeVetta Lee has been the primary drafter in initiating this. She's the strongest we have from a defined contribution standpoint in this area, so we really appreciate her work and effort. It's also a team effort for many others, and if I leave anybody out, certainly not intentional, but as she did that, she worked very much with Ice Miller, our outside tax counsel. Also, of course, myself have reviewed it and been involved, but all members of the executive team to some extent. And you may hear from Mason later. Empower had a chance to review. The representatives from the Attorney General's office had a chance to review. Of course, shared it with the board and legislative designees and Senator Sparks as the author, along with all the others. And like I said, if I left anybody out, that was not my intention. The feedback we received, we have incorporated that. Overall, it was pretty minimal as far as any changes. And as I begin to wrap up, I'll just say some of the highlights or the key points of this is, as you've seen, the plan document covers many of the plan provisions for the DC side of the Tier 5 hybrid. It covers the process and the need for employers to submit the contributions for the DC side directly from the employer to the TPA to Empower. That's the way it is in MDC and the other plans as well. And it's very important that they do that, and very important they do that in a timely manner due to the nature of the DC side. There are also provisions in there for a couple of key aspects in the development of the law, which pertain to hardship withdrawals and also optional and variable contributions by the employer. So with that, as I begin to turn it over to Ms. Lee, I know Dr. McCoy, I think late last week you may have talked with her some. She's prepared. We could go through some of the areas of discussion, or if you would like to, we would defer to you if you have particular questions or an area to start with, or however you prefer. We'd be happy to do that.
I'm just gonna let her incorporate mine into the presentation because she and I talked through the comments and questions that I had, so.
Sure. Well, that sounds good. So, Mr. Chairman, if that's all right, thank you for the time, and DeVetta, please proceed.
Good morning. Again, I'm very happy to present this first version of the plan document to you all. Thank you for those who provided feedback, comments, edits, all those things. We're very appreciative of all those who worked on this. Ice Miller, we do have Audra and Rob, who you all are familiar with. They are online. Rob, Audra, say hello. Can we hear you?
Hello. Yes, we're here.
Yeah, good morning.
So we do have Ice Miller online to engage if necessary with any particular federal law concerns or questions. But we can just go ahead and start. As Mr. Higgins says, this looks very similar to what you're familiar with seeing in the ORP plan and the Mississippi Deferred Comp Plan, as it is a defined contribution plan document. This is the board's first official review, and we will file this with the Secretary of State. We treat it as a regulation. It will be filed now and then in October, of course, with go live March 1. But this was a very important first step to get some things clear and concise and understood among the board as well as staff, so that we can begin building employer guides, employer handouts, trainings, information for our participants who will be joining this plan next year. So with that being said, the first section is simply just an establishment, and then we go into definitions. The definitions are important here because they do make sense of some of the words used later. I know one of the things Dr. McCoy pointed out was the word code is defined here. So when you see code section 415, that's federal law, IRS language. I know that may be, for some of our lawyers who are here, that may be unusual because you're usually thinking about Mississippi law, but it's defined as the Internal Revenue Code. I have Dr. McCoy did send a highlighted list of things. So I will just kind of work my way through some of those. Some of you also had some similar questions. So if we go to 2.7, compensation, and this language was derived from either PERS regulation or another document, but their question was like, what does compensation not include in the last sentence? And I did want to be clear, because this is an issue that does come up in PERS as well. If it's earned compensation in PERS, it would be earned compensation in this plan. One example that we've experienced at the universities may be a severance pay to a coach where they have a contract and they're being paid out for the remainder of their contract, but that is not, they don't receive service credit because they're being paid out of a contract, because they're not earning it and working it. So that's an example where they may receive compensation post-termination, but it is not in PERS or in this new hybrid plan either. So that's just one piece of clarity. A lot of these things are really not new processes to how we handle things already in the DB plan. We just had to be clear about that in the DC plan as well. We did talk about participation. If you turn to section 3, who's eligible to be in this plan? Any new eligible employee in a covered position. If you're covered in PERS, you're covered in this plan as well. If they are transferred or reclassified to a position that does not qualify for participation in this plan, then they will cease to participate. And that's no different from PERS. Say, for instance, you've been a full-time employee and now you've had a change of life experience, and you'd like to, you had a baby, you had a surgery, something's different in your life, and you say, I'd like to go to part-time. I can't really manage a full-time role. Just like in PERS, if you're not working enough hours to be eligible for benefits, you would no longer be in PERS. Same thing with this plan. Just because you're in the job working for the employer, if you reclassify to a non-covered role, then your participation ceases. So there's no choice. It's just if you're eligible, then you're in, and if you're in a non-eligible role, then you would not be in. Section 4 let's talk about plan contributions, and I'd like to spend some time there because this has come up. As Mr. Higgins said, we're really making many plans about employer outreach, but we've already started some of that, and this is one thing. Mr. Higgins sent out a letter to every employer in our plan about this, and we've actually met with some as well. And so section 4.1 talks about the participants. 5% of their pay will be going to this plan, and they shall be remitted to Empower, the TPA, within 5 business days following the end of the month in which such amount is withheld from the compensation of the participant. So that means that's PERS. You're already supposed to remit to PERS within 5 business days of the following month. And then in addition, they will not be considered delinquent contributions until after 15 business days. So that gives an extra couple, 10 days or business days or so, 2 weeks for us to fix it. If they've made a mistake, if we don't know what to do, we're lost, help us, they have an extra 2 weeks before it becomes a delinquent contribution. And we vetted all of this with Ice Miller about a process and how to make sure our participants are made whole. As Mr. Higgins mentioned, when you have a defined contribution plan, it's not quite like PERS where we just fix it on the back end and make it work for you. You're missing opportunity to invest your money. So it's going to be very important that our employers are well trained and understand that they need to get this money to Empower timely, because it could be a running bull market that you just missed because your employer didn't make the proper contributions on time. So those are some of the things that we've had a lot of discussion with Empower and with Ice Miller about how to make sure our participants are protected and how to make sure that they are made whole in circumstances when they are not remitted properly. And as I said, in the DB plan, we can charge interest, we can fix it, we can make some changes. In the DC world, they've missed opportunity. So it's just a different way of thinking about plan participant adjustments and things like that. The employer contributions, as you understand, they may elect to contribute. If they do elect to contribute, they will have to do a participation agreement with PERS, and the participation agreement is defined in our definition section. We will be working with Ice Miller to make sure all of that is totally above board and in compliance with federal law. But the way this plan will work is that employers who wish to make employer contributions may do so, and they will complete a participation agreement with this plan to lay out the terms of their participation and how they're going to make those contributions, who's going to get them, what the specifics will be. And those will also be remitted 5 business days. Yes,
I might interrupt right there. One of the questions that I had on the employer contribution was the flexibility of the employer, whether they might make a one-time, 1-year contribution versus when they make a contribution that it is the same amount every year. It's not a cumulative sort of thing. So the flexibility is to the employer
That's right.
to do that anyway. And one of the questions that I had, Dr. Smith, was the contractual. Teachers are under contracts, and how the contracts would actually work, and I don't know. I've been away from it so long. If you were to, rather than increasing the supplement, you would increase the retirement contribution, and you would add an amount. And how would that have an impact? So that was just one of the questions that I had on those people that do have employment contracts versus the at-will employees.
And if we look to section 4.2, there's some clarity there. Any changes to the employer contribution rate shall be adopted by the employer no more than annually and shall be effective on the first day of the plan year. Of course, we're on a July 1 fiscal year, following the adoption and notification to the board. Each employer shall enter into a participation agreement with the board specifying the amount of employer contributions adopted for the plan year. So this is our starting place. We're saying we want it at least, for the plan year. We may get to a point after we're more comfortable where that could be adjusted by this board with this document, but in conjunction with working with Empower and Ice Miller, we thought that was a safe starting place to get folks going, that they can make an employer contribution and they would do a participation agreement with us no more than annually.
One other comment here, and I think the better and I talked about this, was employer training on the changes and when that information will go out to the employers and what changes in the process, procedures, and the penalties and how all that works. How soon will that go out, so to speak? Because, well, in March, people that get hired, and if they're finishing out a current school year or something like that, all of a sudden they're in Tier 5. So employers need that training as quickly as possible. So
we have a full team working on implementing all of this. So there will be strong employer trainings. Shelley's already drafted some guides and materials that we're still fine tuning, but Mr. Higgins is leading our plan. Lauren is here, who is our staff team leader on the plan. We have a full out, we're ready for that. It will happen this end of this year for sure. So by March 1, every employer will know about this plan and how to enroll the folks and all those things. We have new pins. We're working on it aggressively, sir. The first step is this. The first step is getting the message clear with you, the board, giving good instruction through the document, as well as the regulations that we'll discuss tomorrow. And then once those are all clear and there's not as many questions about how are we going to do it, when are we going to do it, when is it late, what do we have to do? So this is that first step.
I had shared that with people that have asked me, how do we and how's it going to impact our process? I said, the board's got to adopt the plan first, and then it comes from an outgrowth of the plan. And I also told them that they'd see some changes in regulations as well, because they go hand in hand.
That's right.
And the regulation changes will be because of the plan document, so.
Yeah, that's exactly right, and I would just echo that and mention Empower as well. There'll be some information from Empower and coordinating from that. And while we have a little bit of a pause here for questions and discussion, let me go back just a little bit while we're talking a little bit about compensation and contributions and stuff. And thank Chairman Benson, really appreciate his help and input in developing the plan document as well. Not just as a board member and chairman, but also as a local fee-paid official. I didn't mention that earlier, so definitely wanted to recognize him and thank him for his contributions. And as we turn it back over.
Oh, I'm going to get to fee-paid in just a little bit. We're going to try to expedite
I wasn't sure if
this.
you were going to cover it.
I'm going to try. I have to say thank you, because it's so nice to have a local fee-paid official. I have learned more about fee-paid officials. I think Mason has learned more about fee-paid officials since March than we've ever known. So we were going to get there.
More than what you ever wanted to know.
That I ever wanted, but I do. I love learning new things. So you have taught me a lot. We'll just talk about the military service, because a couple of board members did ask questions about that. We already offer this under USERRA. They can buy their time away. If they're called to active duty, and they return back to their employment, they can buy that time in PERS. Well, what this just says is they can also make those contributions that were missed for their DC portion as well. And if the employer has already elected to make employer contributions, then if the member pays, the employer has to pay their part as well. So this is really no change. This is just the DC side of it. They already can come back and buy that service credit, pay those contributions to gain that service credit. In the DB plan, it's always been, it will always continue. This is just the DC side. So nothing's changing there.
Debater, would that be the same for somebody moving in from another state that wishes to buy back their time that they missed?
No, we're not going to have buyback. We're not going to have those out-of-state service purchases in the new tier. This is about military, what I'm referencing now.
Right,
if you are in your job and you get called up to active duty, the federal law wants us to make those folks whole, give them the opportunity to get whatever service credit they missed or even contribution payments that they missed during their time serving this country. So this is just no change. This is just talking about the DC side of USERA, which is you've been called up to active duty.
Doesn't matter what state they're from, military service is gonna qualify.
Yes.
Was irrelevant to the state.
That's right. That's right. But in USERA, you were already in a job, a PERS covered job, called up, came back to a PERS covered job. So it's, yeah. But for the 4 free years of military service, that is unchanged. And that doesn't matter where you were stationed or, yeah. Is that what you were trying to clarify?
Yeah, it just doesn't matter what state. If it's for military service, you can be in Tennessee, you move here. If you didn't have that already, you would be able to
That's right.
bring it. But if you did capitalize on it, if you were in Tennessee and got up to that 4 years, let's say, there, you can't transfer that here.
If you got, I'm sorry.
So if you got credit in Tennessee's retirement system, that's the part you're talking about that you can't transfer here as other states' retirement.
Right. If you were a
pieces,
school
right?
teacher in another state and now you've moved to Mississippi and you want to just buy your time there, the new tier will not have that service purchase option. But this is, we're not talking about
It's
that. We're just
gonna
talking
be
about
in that other
military.
retirement system, not here.
That's right. That's right. And section 4.4 talks about rollovers. Oh, there was a question?
I'm sorry.
Yeah.
But when you leave, like for military time, as soon as you come back.
That's right.
You have to make that decision right then.
That's right.
Okay.
When you come back to active covered PERS covered service, then that's when you start working with PERS and getting calculations to get everything paid off. That's
And
right.
there's a timeline that you've got to get that paid back.
That's right. It's 3 times your service time, so up to 5 years. So that could have been a 90-day or a 2-year, whatever it is, 3 times the time you were gone, up to 5 years.
Okay.
Yeah. And we actually, we don't get them often. I've probably seen 5 since I've been here, USERA purchases. It's not often, but when we do get them, they are usually eager beavers to get it handled, so. Rollovers, we will allow rollover contributions from other plans, and this is something we've talked a good bit with Empower about. We already allow this in deferred comp. So if you were in a 401k in your private sector job and now you've come to make public service your career, it gives you the opportunity to roll that 401k into the plan. It will maintain its source identity. Did I say that right?
That's right.
So if it was a 401k, Empower's still going to treat it like it's 401k money. It's not going to become 401A or 457 money, but they can account for that. They already have systems built for that. Would you like to add anything there?
Yeah, and along those lines, so the roll-in will be separated. So think of the employee contributions having this sort of segment within the umbrella of the account. And if there is a roll-in, it will be an additional source, if you will, label rollover source within the umbrella of the account. Related to that question, though, related to that topic was, for let's say you have a person who will be in the new 401A, and then at some point thereafter, they decide they want to also join the deferred comp plan. Which one would be advantageous for the roll-in? Like, that was kind of the question. Well, given that the investment options are essentially the same, the fee structure is the same, there's really not much advantage. So to her point, we're going to maintain the integrity, if you will, of the type of rollover. So it wouldn't matter if they roll it into the 401A versus the 457 in that work.
Addressing the commissioner's question, let's say you were in Tennessee and Tennessee has a rule up there that you cannot leave your money beyond 7 years in their system. You have to take it out. So if you happen to have worked there for a number of years and then you choose to come to Mississippi, you could take your retirement money, roll it over into some sort of investment instrument that they have, how much ever you've got in their retirement system. Then when you come to Mississippi, you can roll it over into the deferred comp portfolios, and then you have not lost your year's investment, and you keep it kind of all under one roof. Is what you would be doing.
And sometimes it's just
But
easier.
you can't just bring it in and buy years. That doesn't happen.
Well, my question was, all right, I've taught school in Mississippi 10 years. I got mad about the salary, so I ran to Louisiana and taught for 3 years because their salary was better.
Yeah.
And it wasn't as good as I thought it was, so I come back to Mississippi. Is there any mechanism for me to buy back that 3 year that I ran to Louisiana whenever I was mad?
No, not in Tier 5.
Okay,
It is not.
That's
that won't be a problem?
It's just the way the new tier is designed.
Well, there's no contributions paid in Mississippi, so that's part of the issue is if we're gonna pay out a benefit and give them credit for those 3 years they were in Louisiana, Louisiana paid their contributions and they paid their contributions to the state of Louisiana's retirement system, and they're gonna receive whatever benefit from Louisiana that they bargained for, that they paid for. If the state of Mississippi gives 3 years of service credit for work done in another state, there was no contribution to PERS, which is unfair to PERS members, that they're absorbing the payment for out-of-state service that no one paid a contribution on in the state of Mississippi.
But if I took my 3 years retirement and cashed it in Louisiana and applied it to Mississippi, that's not a washout?
I don't know that the law allows for somebody to come in and take their money into the defined benefit portion and try to come in and purchase that with money from Louisiana. I don't know that that's what was happening. I think they were just getting credit.
There was a purchase.
Okay.
It was a service purchase under the previous tiers, but under Tier 5, most of the service purchase will be eliminated. So you have to earn it the hard way, working for the state of Mississippi.
Well, they shouldn't have left.
I think he's asking if he were to take those contributions, would he be able to add those contributions to the DC?
Oh, to the DC, yes, you can roll it into the defined contribution plan.
Okay.
Absolutely. That's
Okay.
what Dr. McCoy was referencing.
It would be.
Okay.
You can roll it in and keep growing it here in our plan. It just wouldn't be a
Because
pension.
that piece is the important part, because we do have people, whether they go to Louisiana or not, or they leave state service, they still have that availability when they come back to roll that back in. Their DC piece is growing. The other thing that, and correct me if I'm wrong, whatever they had in another state, when it rolls in, we're not going to convert it to a 401A. That may be a federal tax law issue, but they will immediately have a 401A, which means the optional variable contributions can be made. That's the reason it's a 401A, is that we want to give employers flexibility to make those contributions. So if they didn't have a 401A when they came, they'll have one.
That's right.
If they were in state service here, left for a period of time, came back, they'll still have a 401A, correct?
That's right.
All right, thank you.
Yeah.
We've got 15 minutes left.
Okay.
For the rest of this document, so you go ahead.
Section 4 is the hardest part, so.
But there is one difference between the 401A and a 457. Isn't there, in that you don't have to take that RMD if you're still active at a certain age? Is the 401A work that? I guess it would work that way too, but it's a little bit different.
I don't know, honestly, right off the top of my head, but I imagine if you're active and still working, you would not have to take it out of the 401A either, but I can.
This is Audra. Yeah, the RMD rules in that respect are the same for the 401A and the 457, in that if you're still working, you don't have to take an RMD. One of the key differences in a governmental 401A and a 457B is in a 457B, they can make elective contributions pre-tax, so they can contribute 7%, 9%, they can change it. In a 401A, the pre-tax in general, the pre-tax contributions cannot be changed in the same way a 457B can.
And then the overall limit, of course, is still subject to that on the 457. Okay, thank you.
That was maximum contribution, section 4.5. That's not changing. We already handled this on the ORP plan. There are limits that the IRS will allow, and those limits change annually based on cost of living measures. There was a question about EPCRs, and while we have Audra and Rob, I would like to just address that. The question was, well, who's going to handle that? What is EPCRs and how does this work? There are federal rules dealing with employee plan compliance resolution systems. So whenever there are adjustments or reversions or all these things, it's important that we follow that federal law, and Empower is well-versed on all of those things. They already do that in our plans and others. And this is just federal language that Ice Miller wanted to make sure was clear in our plan, that we would be following federal law. I will like to talk about allocation of plan contributions. We'll talk, I think was mentioned already, that we're going to use the target date as the default, but it does say on page 10, section 4.7, that contributions shall be forwarded by the employer to the TPA and may be allocated by the participant to one or more investment options. And I'm going to get to the investment section real quickly, but I did want to stop on page 11 with 4.8 again and thank Mr. Bill Benson for all of his help in understanding fee pay. I'll tell you, fee paid officials not really designed for defined contribution plans, right? It's very complicated. So we did a lot of deep dive to make sure that this was good language, and I thank you for that. Fee paid officials, we already have those in our counties. Particularly clerks and constables. We also have coroners, but that's something we'll talk about tomorrow. They're a little different. But particularly in chancery and circuit clerks and constables, they receive fees all year, but many of them don't actually remit to PERS on their fee until the spring of the following calendar year. It's due by April 15th. They file with PERS, they file with the state auditor's office, and there's a lot of reconciliation that happens by Mason's team here at PERS. And so making that fit into a defined contribution plan was it was a lot, and we thank Ice Miller for their efforts as well. So anyway, this language has been vetted by many, and we think it's going to be fine. It's really no change to how we handle things already, but just there were a lot of questions and concerns that came up. They will still have to remit to PERS by April 15th, and then after April 15th, they will be considered delinquent and have to pay those delinquency corrections, if you will, to make themselves whole for the time they did not pay during that calendar year. I don't want to go too deep, because let me tell you, Mr. Benson had to explain it 3 times to me. So I know publicly this will be a hard conversation.
Just note that going forward, section 4.8 will be known as the Bill Benson
Bill Benson section. I love it. I love it. So we'll move quickly. Section 7, let's go to Article 7, where we're talking about investment options. I do want to bring attention to Section 7.3, the investment default. If the participant, now we do want the participants to control their own account. We want them to go in, make selections, be an active participant in this. And that is, I think, the legislative intent. However, we know there are some people who will not. And so we have some language here that says, in the event that they fail to select an investment option, upon enrollment in the plan, the board shall direct those contributions to the target date fund with the target year closest to the year they will reach age 65. And there's already mechanisms set up like that in Empower. We already have the Vanguard target date funds in deferred comp, and we'll have those as well. They're very low cost, great returns. So Shannon has assured me that they have a process to set that up. If people have there's no option selected, they'll go in target date.
This is one of those things that the employer really needs the training on. If you don't come in and make this selection, it's going here. I mean, that's just the way it is.
And at the top, Dr. McCoy, you did have something on that first sentence of 7.1, that the board shall screen and approve any investment options under this plan. This is no different than we already do in PERS and deferred comp and ORP. Y'all have Callan reporting out and explaining all those things. Let's go in section 8. I would like to talk to the senator here. We do have the unforeseeable emergencies. I think you used the phrase hardships in the statute, but that's the federal language that is here. We will allow unforeseeable emergencies. In accordance with federal law, we already have this in deferred comp. If you have a casualty of property, if you have funeral expenses, medical expenses, there's already some federally allowed situations where you can draw your money out of deferred comp, and we will have those as well in this plan. We also will allow the participants to make their own self-directed explanation. When I first started here, it was they had to submit proof that they were about to be evicted. They had to show the medical bills. They had to send all these supporting documents. During Secure Act, that some of this language was changed, eased, if you will. There's not as much regulatory oversight and review. They can justify it as a participant. Here's what I need, here's why, and we can rely on that, and Empower can rely on that. So they're working to make sure that that's getting up to speed for both of our plans. Yep. Some of this language about distribution to beneficiaries and minors and anyone who's incompetent, this is very similar language that we already have in the deferred comp and ORP plans, and most of that is led by federal law, and ICE Miller has provided a good bit of that for us. The 8.12, this came up with one of the board members, unused leave, and this language is very closely, it closely resembles the ORP plan document language. And I know Dr. Rutledge brought that forward at our last meeting about unused leave. What happens with, if you have all this unused leave, what happens to it? And I was so happy when he said, we already have this in ORP. They don't get it. That's just, they have what's in their account, and that's how this works. So this language is very similar. They can still be paid for their lump sum leave payment in accordance with state law. And that's how that works. Any remaining unused, uncompensated leave lapses upon retirement or severance from employment. And that has been the way in the ORP plan, which is a straight DC plan, longer than I know. So it's always been like that as far as I can see. So that's referenced here. Authority of the board. I know when I sent it to you all, I said we don't have a code section yet. We still don't have a published code section. I checked with the lawyers over at the Capitol at the end of last week. So we just put 25-11-101 at SEC, which means in the code sections that follow 101, which is where we know this is going to be in Article 3. So that's in Section 9.2. This was very important, brought forward by Mr. McCoy, I think Mr. Benz. Several of you all talked about how we're, Mason, how we're relying on the information from employers. And that is in 9.3. To enable the board or its designee to perform their functions, the employer shall supply the necessary information to the board or its designee on a timely basis regarding the participants under the plan, including compensation, hire dates, death dates, severance, all these things, and that the board will rely on such information as is supplied by the employer and have no duty or responsibility to verify such information. In the event of an error, the employer shall use good faith efforts to coordinate with the board to correct the error. And this is no different from our DB plan already, but I know that kept coming up, or how are we going to know? What if they don't tell us? What if they do it wrong? We are always relying on the information reported to us by employers. And when we find that it's wrong, we fix it, but we don't always know it's wrong until we find it, right? So we have to rely on what our employers tell us, and that's no change in this plan. Okay, Section 10, non-assignment. That's always been the case in PERS. It's not subject to levy, garnishment, domestic relations orders, any of that. We do have the right to amend the plan. Of course, that was in the statute, but we could have a plan document amended from time to time. And then we will be in compliance with federal law, Section 401A. And of course, everything in PERS is always subject to accordance with the laws of the state of Mississippi. Venue for resolution is in Jackson, Hinds County. If a dispute arises, the TPA may delay payment until after this dispute is resolved by a court of competent jurisdiction or is settled by the parties involved. None of this is changing. So this is the language that we already have in our plan. And finally, Section 13, a trust will be established under state law. Empower will be handling this trust for us. And the board is the trustee for all assets of the trust. If you have any more, that's kind of a quick and dirty overview of sections that were brought forward and sections I just thought we really, especially Article 4 is the heaviest, dealing with contributions, money in the plan. So any questions?
Wow.
Motion to adopt.
Is there, all right, all those in favor say aye. Any opposed? Motion carries.
Thank you, gentlemen
Initial
and
adoption.
lady. Thank you so
Thank
much.
you. Thank you.
While we're changing, does the board need to take a 5-minute break?
Let's do the miscellaneous updates and be done
That'll
with this
be fine.
committee.
I got a question for the executive director. Now, we have heard the hybrid defined contribution plan presented in the defined contribution committee. I'm assuming that the defined contribution, since it's very similar to, they're going to be handling it, that all of the investment activities and reviews will be done in this committee going forward.
Well, it could be. That was actually something I was going to discuss, and we can do it now or later in another
Doesn't
committee.
make any difference. I was just making a comment that it's here now.
Sure. No, great point. Well, I tell you what, happy to talk about it now, but if agreeable with you, just in the interest of time on the break that you just mentioned, be happy to do it in the investment committee.
Whatever.
So let's do the miscellaneous updates, be done with this committee and take a break.
Mr. Chairman, if you would indulge me for a very quick moment, I would like to go back to one topic we discussed earlier, and that was how to, keep people from leaving deferred comp. One thing that I get a lot of phone calls from people that are, thinking about retiring, et cetera, and they're being contacted by outside advisors, retail advisors, and while I cannot give them financial advice, what I can tell them is this, and then what I do tell them is this, is that investment returns are not guaranteed. All right, but fees that you pay, what you don't pay in fees, you get to keep. Now, what I can tell you is whether it be PERS or MDC, me and my staff are extremely dedicated to making sure not only that we get a extremely robust selection of investments that people can use, but we get them at the best price that you can. And one thing I'd like to point out is, for instance, Callan produces this every single quarter. And I don't think we focus enough on how powerful this one page is in showing what we do. For example, the Northern Trust S&P 500 Index Fund. An S&P 500 index is an S&P 500 index, whether it's managed by anybody in the world. But what we do is we give the ability of participants in our plan to have access to a broad market index like the S&P 500 for 1 basis point. I used to work before I came to PERS on the retail side. I know how much it costs a retail investor to be able to get access to investments. And you're not getting it for 1 basis point, period. This is as close to a pure index return you can get as an investor. So that's one thing that I like to point out, is that what needs to be done when questions come is we need to make sure that we're informing our participants that they need to ask questions about how much is this going to cost me on the retail side compared to what I'm paying with MDC, and what they're going to pay to get access to what they have access to here already at MDC is going to be higher. I can almost guarantee it. So that's one thing that I just wanted to get across to everybody on this board and anybody listening. So,
Can I add one thing to this? I should have said this when I was here. I would say that the secret is out about deferred comp, that it's a great plan. And it may not be out amongst our workforce as much as we want it to be out, but it is out amongst the investment professionals in our state. And we did a deep dive several years ago about the money rolling out. Where is it going? Which banks, which entities are getting our money? And it's usually because, Mr. Benson will remember, it's because they have a friendly face, maybe even a retiree, smiling and shaking hands saying, come on, roll your deferred comp into my plan, let me manage it for you. So Shannon knows the regular players because they have to agree to roll the money out. They know where the money's going. We've researched it. We created a stay in the plan document where it had all the details of Mississippi deferred comp on one side and blanks on the other, and said, take this with you when you go meet with the person who's telling you to roll your money. Take this form, fill in the blanks, ask them these questions. We've done a lot of that work. If we catch them before the investments professionals catch them, we usually can persuade them to at least strongly consider staying in the plan. But if it's their neighbor, brother-in-law, banker down the street, I had a sweet lady who told me, she said, ma'am, I'm rolling my money to the trust mark down the street from my house. She lived in rural Mississippi somewhere. I said, ma'am, your money won't be at that trust mark. You understand that's a branch. She had a large balance, likely won't be in that bank. And she said, I know, but I like to just walk in and talk to people and get my money as I want it. And I'm comfortable there. And guess what I said? Well, I wish you the best. It's her business. It's her money. We can't stop them. If that's what they want to do and they want to roll it out to their local, church member who helps them with investments, we can just tell them, ask these questions. And we've done that, and we'll continue to do that as we have more. We see it in ORP, we see it in deferred comp, and we'll see it in the new hybrid plan, just because there's an industry out there and they know that we have good plans. Good. If you listen to Talk MPB, they talk about if you're a public employee, you should be in that deferred comp plan. That's amazing. So the secret's out that it's a good plan, but when people have a large balance, just like a PLSO, there are people out there waiting, hoping that they will roll that money into their investment brokerage so that they can make money. So I just want to say that.
Thank y'all. Miscellaneous updates.
Miscellaneous updates, real quick. There's a news article here, Voya and Blue Owl Capital. Blue Owl is one of the firms that we've retained to run our private credit program. This is just informational, just showing you that private markets are becoming more mainstream through the use of, things like ETFs and CITs. So that is all I have, sir.
Thank you. The committee is adjourned. We'll take a quick break before the investment committee.
Yes, please. 5-minute break, or as close to it. committee to order. Charles?
Thank you, Mr. Chairman. Before we start, I'd like to take a few comments. Public Employees Retirement of Mississippi had another great year for investment performance, posting an 11.66% return for fiscal year 2025. This was on the back of the recent resolution of U.S. fiscal tax policy that brought a lot of needed transparency to the economic landscape, offering a reliable framework for businesses, regulators, and investors, coupled with the robust market performance after it realized that it completely overreacted to tariffs, and seeing that the economic outlook is notably more optimistic than it was earlier in the calendar year. While global instability posed serious challenges, financial markets largely defied the noise. History reminds us that reacting impulsively to geopolitical shocks often undermines long-term investment success. Staying anchored to our strategic asset allocation remains a very prudent strategy. After a rocky market in March, marked by tariff concerns and recession fears, market staged a very strong recovery from April through June, with the S&P rebounding from a 19% dip in early April. Gains extended beyond tech, with standout performance in industrials, communication services, and financials. The Magnificent Seven delivered mixed results, with Meta and Microsoft and NVIDIA gaining, and Tesla, Apple, and Google declining. Global equities during the period outpaced domestic equities for the quarter ending June 30. Developed markets, as measured by the MSCI EAFE index, were up 19.9%, and emerging markets, as measured by the MSCI Emerging Markets Index, were up 15.6%. A softer U.S. dollar and improving European conditions in the economy sourced that rally. Just a quick update on private equity. Private equity remains neutral but stable. The quarter saw 222 thousand transactions worth $260 billion, up about 11.8% in volume year over year for the quarter, and 36% year over year. Private real estate is stabilizing amid uncertainty. Performance for private real estate returns strengthened after bottoming out in 2023. So key takeaways for the fiscal year: diversification pays off. Developed and emerging international market equities outperformed U.S. large cap, and staying invested and following the asset allocation policy matters. Volatility happens, but those that remain disciplined are generally rewarded. So far for this current fiscal year, 2026 update, you're gonna like it. The S&P rose approximately 3.3% as of close August 23rd. Despite geopolitical tensions, tariffs did not deliver the inflationary punch that many feared. Retailers appear to be absorbing the costs, and U.S. markets remain resilient. International equities, developed markets rose about 4.3%, and emerging markets rose 2%. So for PERS, so far this fiscal year to date, we are up almost 2.5% at 2.46%. A very good start to our year. And with that, unless there are any questions, I'd like to hand it off to our representatives with Kellen to give you a update on performance for the portfolio.
Thank you, Charles. Good afternoon. Good morning, all. Certainly, we're happy to bring the cool weather, 81 degrees outside, so we're really enjoying it down here. I'm in from Chicago, and Alex is in from Denver. It's always a delight to be here in person. I'm going to be going from the deck It is labeled the Executive Summary Performance Review. This is the defined benefit fund that we are going to be talking to this morning. Certainly, as always, if anyone has a question while I'm delivering the comments, please, no need to wait till the end. Stop me. Appreciate the feedback. So let's turn to slide 3. And as you look here, this is a one-page summary, kind of a takeaway tear sheet, if you will, as of June 30th. The fund assets stood at $36 billion. It's an increase of about $2.2 billion from the prior quarter end. And the positive increase was due to investments up $2.4 billion and reduced by net outflows of about $210 million. So that is kind of typical for the quarterly drawdown, with the exception of the fourth quarter. Asset allocation, first and foremost for trustees, we're certainly within what we would expect, within 2% of targets. And again, the idea here is we saw that the non-US portion had increased a little bit largely due to outperformance, but again, within 2%, very close to our targets. The chart you see at the bottom, this is giving a little bit of the short-term performance, and you can see some of the positive returns, the bars, the third set in international equity. To Charles's point about diversification paying off, it's been quite a long time since we've seen international equity markets outperforming that of U.S. markets. But again, we see that over the international equity, if we look over the fiscal year 2025, almost up 20%. Contrast that with, again, a healthy U.S. equity up 12.8%. That's, again, that one-year number. And global equity, which is a combination of both non-U.S. stocks and U.S. stocks. Broadly, the mix there at a benchmark level is about 64% U.S., 36% non-U.S. And you can see that that's kind of a blend of the two, up 14.4% for the fiscal year. Fixed income generating a 6.7% return. Private equity, 7.5%. Real estate, as Charles noted, having reached the bottom, we believe, and we see a rebound. This is generated largely through income, not appreciation. Again, there's two components in terms of the return that we're looking at. How much are you appreciating the level of the assets or the market value of the assets, and that income component, which makes it a great diversifier with the other asset classes. And we see that 4.5% is largely income generated, appreciation being flat to negative. And cash, again, as we saw the Fed continue to hold rates where they were, generated about a 5%. So for the one-year period, we see that the fund was up 11.7%. So certainly strong absolute and relative returns on most counts. The benchmark was up about 12%, so we're slightly lagging the benchmark due to domestic equity, largely the small and mid caps having active management having trailed over the year. But again, a nice strong return, and that ranks in the 17th percentile of your peer group. So that's looking at funds that the very large pension funds within our universe. At the 17th percentile, you're outperforming 83% of your peers. So for longer term performance over the trailing 5, 7, 10, 15-year periods, we see annualized returns of 10%, 8.6, and 9.7% respectively. So the point there is generating returns in excess of your assumed actuarial return. Any questions there? I'm going to go into a little bit more detail on each of these items, but happy to take any questions at the outset. No? Okay, let's turn to the next slide. We have, again, this is showing the June, the month of June, the second quarter of the fiscal year 2025. And again, as I touched on, we see that over this period of time, the 5-year, the Russell 3000, which is a composite index of 3,000 largest securities in the U.S. market, was up an annualized 16%. The burnt orange, that is your non-US equities. And again, over the 5-year period, up an annualized 10%. Over a 3-year period, up 13.4%. And that's largely built on the back of that 1-year return at 17.8%. The aggregate, again, we see over the fiscal year, the Bloomberg aggregate and the Bloomberg aggregate hedged. Again, so those are non-US bonds that are hedged to the US dollar, about 6%, providing a certainly a relevant return. You may recall that looking back a few years where prior to the hiking of short-term interest rates, fixed income represented the ballast, the tail to windward, but not really contributing a whole lot to the overall portfolio allocation. Well, when you see that they've now, when we look out 10 years based on the Callan projections, offering a projected return of 4.75% to 5%, certainly becomes more meaningful, especially against the backdrop of a 7% actuarial assumption. Any questions there? Okay. Let's turn to the page 6. These are just a few macro comments that I would mention is unemployment rate at 4.1% was steady and low. There were, again, there's people living by the data points. When data comes out, there's also revisions that are taking place that has mixed reactions. But again, the idea here is at 4.1% or 4.2 that was read earlier. These are again low unemployment rates. The gross domestic product, which is a measure of growth of the economy, was up about 3% for the second quarter. And CPI, so that's your inflation metric, was at about 2.7. So consistent. And again, the Fed projections, they are looking at some point as they strive to get towards that 2% target. Expectation is that it might be 3% in the short term, but outside of 2027, their long-term goal is to get it to 2%. So Fed, no action taken in the last 5 meetings, the most recent being in July. There was oftentimes you have a unanimous vote coming out of the Federal Open Market Committee. This time we did have two folks dissenting, wanting to lower rates. So that might be in the offing for the upcoming meetings. The targeted amount, the last survey that was done, it's called a dot plot, was done after the June meeting, and there was an expectation that there would be 2 cuts to interest rates. So again, there's some speculation looking forward to a cut in the next few meetings. With that, let's turn to, there is a snapshot of the dot plot that's a little bit dated. I'm going to turn to page 11. This is again the familiar table of a host of returns. Most of these I've already spoken to, but just to kind of put it in the context here on a historical basis. Again, the S&P 500 was up 10.9%, so almost 11%. U.S. small cap, 8.5%. So certainly we saw in the first quarter, we saw negative returns and a nice rebound here in the fourth quarter of your fiscal year. Again, looking at the global markets, we see that, the developed was up 12%, emerging markets up almost 12%, and even small cap up 16.9%. So again, what we've seen here is the contribution from non-US equities. But it's interesting, if you look over the last 10 years, you can see that the Russell 3000 up 13%, or the S&P 500, which is another US large cap index, up an annualized 13.65%. Contrast that with the non-US, which is up 6.6%. So again, we see non-US stocks delivering strongly in the last year. The weakening dollar has been a tailwind for US investors investing abroad to the tune of about 10% year to date. Private equity, we see that over the 1-year period, based on the Cambridge Private Equity Index, up about 6.3%, certainly trailing the U.S. equity markets, which we said have been on fire. If you were to look at the S&P 500 going back to 1926, annualized return is about 10.5%. So when we look and we see over the last 5 years, the S&P 500 up an annualized 16.6%, or over the last 10 years, 13.6. We see that certainly U.S. equities have displayed exceptional returns during this period of time. So, but even with that, if you look over the last 10 years, private equity up an annualized 13%. Again, they've been, private equity's been challenged, level of interest rates, the number of deals done, the fewer companies coming to market. So while, again, it's a long-term holding, our expectation is to generate some 2% over the public markets over long periods of time. Real estate, we can see that, as Alex had touched on, REITs, which are, again, publicly traded U.S. real estate stocks, are highly correlated to small cap, U.S. small cap indices, was down 1.2%. We see over the last year, generating a return of 8.6, which is pretty much in line with the Russell 2000, which is the domestic small cap. The NCREIF index you see there, that is an unlevered private real estate index, and you can see that that's been challenged over the last 3 years, 5 years, but certainly longer periods of time, generating some strong returns and a good diversifier. On page 12, here we have, these are the U.S. equity returns. And again, what I would highlight here is, as you look to the bars to the right, the Russell 3000 is the broadest. The Russell 1000 is the largest 1,000 of those 3,000 stocks. And again, with a comparable return of about 11%. Growth stocks. So when we think of growth stocks, we think of AI, we think of information technology, certainly the darlings, the Mag 7, generating strong growth here. And we see over this, over the quarter, up almost 18%, and contrast that with the Russell 1000 value, which was up 4%, which is, again, more higher yielding financial stocks make up a greater portion of that index. The Russell 1000 growth is approximately 44% information technology stocks. So goes information technology, so goes the Russell 1000 growth. And you can see below, when you see the categorizations, and this is within the S&P 500, information technology represents about 24% of that, the S&P 500. So again, strong performance on information technology, consumer discretionary, another strong growth sector of the economy, up 11.5%, communication services up 18%. So again, we see very strong quarter across the board, but certainly the financials, 5.5%, large healthcare down about 7.2%, greater portions of the value index, so trailing. And again, as we look over at the small cap stocks, we can see that they've, on the growth side, up 12%, and on the value side, up nearly 5%. So again, growth outperforming value in this particular cycle. When we turn to page 13, again, this is just giving you some indication is, by one metric, how rich are U.S. stocks by comparison, and the standard deviation. We have the 30-year average at about 17 times earnings is kind of the average market multiple. We take one standard deviation each way, that represents about 66% of the observations. And we can see at 22 times the June 30th value is a little bit rich, but that's based on success. So there's the success, particularly in the larger cap stocks, where they're more attractive to investors. There's the sentiment that on these growth stocks, they're expensive, and they're expensive for a reason, because they keep generating excess returns over the median market multiple. I think I've already hit the non-US hard enough. Let's go to page 18. And what we're illustrating here are the two private real estate indexes. One is the Encreve Odyssey, ODCE, and the other is the Encreve Property Index. And let me highlight the difference between the two. The Odyssey is a collection of investment managed funds. These metrics contain leverage. The Encreve Property Index is a list of a large basket of private properties that is not levered, but valuated. So you can see that over the last year, the unlevered property index was up about 4.2%. Contrast that with 2.7 for Odyssey. And again, in a negative or a lower returning environment, that leverage is a drag on performance. And as we see that, certainly that was the case over the last 3 years, where you see, the income component of the Odyssey was about 3%. The appreciation, or in this case, depreciation, decrease in prices contributed a negative 9%. Contrast that with the unlevered property index, which was down about 7%. And again, the income component at 4.5%. So the takeaway here is that longer term, it does generate returns in the, let's call it the 4 to 6%. These are the core real estate offerings. And certainly, by most accounts of the managers that we talk to, it certainly has turned the corner from the doldrums. But we do have some spots of underperformance if we look at hotels down 1.8%, the appreciation component, and office, which continues to be a laggard, right? So laggard for the following reasons. You have office space where people are not going back to work. There's downsizing. So again, that continues to be a drag on performance. Industrials, which has been the darling of the market's been holding up really well, was flattish this particular quarter. Any questions on that? Okay, why don't we turn to, if there's no questions, let's turn to the fund performance on page 26. Here we have the asset allocation, and as I said, in line with the benchmark. Domestic equity, we see that's at the target of 27%. It's about, the allocation actually is 25%, so it's within 1.7%, a little bit below its target. And we see real estate is the other one at 8.5% versus 10. Again, real estate illiquid, so you're really subject to, lagging returns has resulted in falling below that target allocation by 1.5%. Nothing to be alarmed about, and certainly these are all within our expectations. Private credit at 0.4%. Long-term target is 2% in the portfolio as we're making our way towards that. The work has been done, pacing study, but putting that investments to work according to schedule. Next page, this is page 27. This is the cash flow summary. This is a little unique in that you are moving from right to left here. So the March 31st values are housed on the right side of the page. We can see that was 33.86 billion. The investment return for the quarter was 2.38 billion. And about 209 million coming out for new investments. New investment captures cash flows in and out, so contributions, net distributions. To give you an ending value of 36 billion, and that is your June 30 value. In terms of net new investments, you can see in this particular quarter, the source of funds, we had some money was put back into domestic equity to mitigate the downturn from the first quarter. And we see that fixed income at minus 203 million in cash represented your outflows, and your inflows were private credit, additional contributions made, as well as real estate. Any questions? Okay. This is the summary dashboard. So this contains 2 pieces of information. One is to describe the comparison versus the benchmark. And the second is to say, what is the performance compared to its peer group of large defined benefit plans? So we see that over the last quarter, the fund was up. You can see the blue circle was up 7.06% in the table. And if you look up, you see that that blue dot is in the 17th percentile. So that's saying that the performance of 7.06 is in the 17th percentile, outperforming 83% of the 57 funds that are included in that large public fund universe. We see that if you kind of scan across, you see fiscal year to date, the ranking was in the 21st percentile. Over the last 3 years, 31st percentile, 5 years, 38th, 7 years, 25th, 10, 15 years at the 19th and the 15th percentile. So that's the takeaway there is outperforming its peers consistently across the spectrum, both short and long term. And then relative to the benchmark, you can see while it's at 1166 versus 1201 for the fiscal year, over the 5 year, the 7, 10, and 15-year periods outperforming its benchmark.
If you wouldn't mind.
Yeah.
Talk a little bit about the standard deviation for the 5-year.
Sure.
Relative to.
So the standard deviation, yeah, if you look at the right corner, that chart, standard deviation is the proxy for risk, okay? So when we think of, it's great that you have returns, but how does your return pattern compare to the risk pattern when you're looking at the benchmarks? And you can see that here the policy benchmark is a little bit higher on the standard deviation spectrum, right? That's the XY axis. And then the y-axis returns, you can see that the total fund over the last 5 years has generated stronger performance. So what you have is a little bit better performance with less risk. So your risk-adjusted return is favorable. And there's another metric for that. It's called a Sharpe ratio. But suffice to say, that's a nice relationship to see. I mean, there may be some occasions where, given what your target is, you may have to take on a little more risk than the benchmark. But in this case, over the last 5 years, the managers combined with the asset allocation have performed well and delivered returns that are in excess of the benchmark with less volatility or less risk.
John, if I could just add one comment to that. We think a lot of that profile also comes from the use of private markets, which has a smoothing effect to the overall plan results, right? They're not as volatile up or down because they're appraisal based. They're not, traded throughout the day like on an exchange. So introducing private markets, this is one of the benefits that it can bring, is you can have a higher return and a lower standard deviation, which you've seen evidenced over the last 5 years for PERS.
So the analogy is you have a great home and your value is based on maybe other sales that have taken place in the area. So it's kind of appraisal oriented until you actually go out and sell your home. That's when you realize the return. So when you're talking about private equity or even private credit on a shorter duration standpoint, those interim valuations, that's why we say long-term investment is kind of a truer metric in terms of the overall performance. In the short term, particularly when public markets are raging, you're not going to see the same level of outperformance that you would from a private equity. But certainly over long term, it will reach fruition.
I do have a question, if that's appropriate. The private equity piece, and I'm just trying to wrap my arms around it because I hear you say we don't have volatility because it's a smoothing effect, because we're relying on what the private equity tells us the actual valuation is. And again, all my appraisals around me are great, but when I sell my house, reality strikes, good or bad. We move from a 5% weight to a 10% weight, and we're still overweighted by a point in private equity. Did I understand you to say, and I may have misunderstood, you expect forward-looking private equity to exceed the S&P or to exceed public equity by 2 points?
I would say when we talk about public equity,
I was just asking what you said earlier.
Oh, yeah,
I thought you said S&P.
I-
Did you?
S&P or Russell 3000, those are two large cap dominated indexes of the US equity market, so they're very comparable. So whether you say versus the public markets, I would say that the public equity index plus 2% is certainly an expectation of outperformance, whether it's the S&P 500 or the Russell 3000.
Okay, so you expect private equity, to which the board raised the weighting to 10% allocation, to exceed S&P, even though for the last 25 years it's trailed it. Because I mean, obviously the future, the past is not indicative of the future. I'm just want to understand, is that the position that you believe private equity is going to exceed those traditional stock returns which they've trailed for 25 years?
Yeah, so if you look for, if you go back to page 11, and you, I'm sorry?
Yes, yes.
And you look at the Russell 3000 or the S&P 500. So the Russell 3000 generated an 8% annualized return over that period, and the S&P 500 is 798. If you go down to the Cambridge Private Equity Index, that's about 10.3%. So historically, it has generated a premium of about 2% over, and that is our expectation for the future, our long-term projections.
But if I look at the more recent years, because correct me if I'm wrong, we're 25 years looking backward. I don't know what 30 looks like, but a year from now, when the 2000 dot-com bubble rolls off of the 25-year Russell and S&P, what's that number going to look like? Because I think it's going to rise when you take that terrible year out of the market. Is private equity also going to rise comparably, or are we going to see a spread? So the real 25-year looking back in 27, will that be 2 points to equity, or will it be the other way around? I just want to understand, because when you said that, that kind of caught my attention. That private equity going forward, you believe will outperform by 2 points.
Yeah, but, and when I say going forward, we're looking at a 10-year projection out, and that would be approximately what we would expect to earn in private equity as opposed to public equity.
Okay, thank you.
Yeah.
Like private equity, up until 2 years ago, for 20 years, outperformed the S&P 500. I mean, it has by far and away been the most profitable thing up until 2 years ago, when it started having issues, mainly because interest rates raised and no one was taking money out from private equity, and private equity wasn't giving loans to businesses for whatever reasons they weren't. I mean, private equity is a safe, long-term investment strategy, especially for PERS. So,
yeah.
I mean,
but
your expectation of them growing, and I agree with your expectation. I think you're 100% correct that it will.
And another thing that needs to be taken into consideration is that the private equity markets are now larger than the domestic equity markets are. And without exposure to those private markets, we are walking away from returns that you wouldn't have access to.
When people have short-term memories, in 08, after the market crash, it was private equity that continued to be successful for most investors after 08, and continued to be successful up until interest rates raised for the longest period of times. And they're sitting, if I'm correct, sitting on large sums of cash that they have just not doled out and are waiting for the Fed to lower interest rates.
Wow. There is a lot of dry powder.
Out of that, yeah. So even with the underperformance over the last 2 years, it's still beating the benchmark by 2+%.
Yeah, for 20 years, like I said, it outperformed the S&P 500. Yep. I'll take that.
Yep.
Is it also fair to say, though, John, that most prudent investors would not expect the S&P 500 or other similar ones to run 1, 3, and 5 years like we're looking at right now?
No.
I mean, is that not, if y'all got any projections, it would say it needs to be year over year 20%?
It's not typical. It's not typical.
Would it even be sustainable
I can't tell you whether it's sustainable or not, but if you look at the concentration in the S&P 500, concentrated in basically 7 companies, you have a very expensive tech fund, you know, if you want to call it that. So I, if I were going in to buy something new and I were looking at the prices of things, I would be cautious spending everything I had on that market. So again, I can't tell you if it's sustainable or not, but history says that markets look for equilibrium and eventually it will find it. So just keep that in mind.
And I would say, you know, each February we come here and we provide we do our capital market projections looking out 10 years. And I'm going to go off the top of my head, but I think our broad equity expectation for the next 10 years, 2024 through 2033, was 7.75%. So, so to answer your question, do we think the outsized returns that we saw in the U.S. public equity market recently are going to persist? No, but that's the number that we're at, between 7.5% and 8%.
And that's kind of the next part, is 22x PE on the S&P. I'm with you. I'm not criticizing in any fashion.
Yeah.
I'm just curious that when you said you believe private equity is going to outperform by 2%, but the historical numbers, I mean, the numbers are what they are. I'm old enough to remember being invested in 99 and 2000 and the pain that came with 27x PE when you look at the chart. So I appreciate that. I think you answered the question, is that forward looking, that's, you answered it when you said the 775 expectation versus private equity.
Yep.
Thank you.
Sure. Okay.
And I don't remember 99 investing, just for the record.
Yeah, I tried to blot it away, but I
think that may be not an age thing, but more of a maturity thing on Senator Sparks.
Compared to me.
Turning to page 29, this just gives you the same information broken out by calendar year returns. And you can see that certainly on a peer basis, in negative returning markets, if we were to look at the 57 or so funds within your universe, your public equity exposure is a little bit higher than some of those. So you're going to reap the benefits, and then in correcting periods like 2018 and 2022, you can see that for those calendar years, while outperforming your benchmark is versus peers a little bit lower. That said, the trade-off is 7 of the last 9 full calendar years. What we've seen is the fund outperform its benchmark and peers. So that gives it the highlight. There's a lot of rates and dates in here. We've got the managers. I'll just close by saying that the performance for the fiscal year has been strong. Long-term, short-term performance has been strong. The struggles that we've had recently would be on the small mid-cap growth side, as keeping pace there. But overall, the portfolio is in good standing and has performed well. Happy to take any questions.
Any questions from the board members? Others? Charles, any comments?
I have no additional comments on this.
Okay. Shall we move to the next agenda item then?
Yes, next agenda item we have is the manager watch list review. I'm going to have Mr. Holliday come up and give you the update on this item.
So for the PERS watch list, we have no recommended additions at this time. If I can get you all to turn to the performance page, I'll kind of take you through there. The first 3 on here, you've got the UBS Trumbull Property Fund, JP Morgan Strategic Property Fund, and Principal International Small Cap. All of those, if you look at the bottom at the 1-year returns, their performance is definitely improving. The peer rankings are looking better, and we're hoping that here soon we can take them off of the watch list. kind of a different story with the next four managers. Bally Gifford, Harding Loebner, Artisan Partner, just struggling right now. One thing they have in common is they're growth managers, and it's just kind of been a rough few years for those. I want to spend a little more time on Bally Gifford. We're recommending that we initiate a search to replace them. So Bally Gifford was hired in September of 2014, and it's kind of, you know, up until June 22, they had outstanding performance for us. Through June of 2021, their annualized performance since inception was 12.18% versus 6.6% for the benchmark. But just a year later, Bally Gifford had a negative 35% return versus a negative 19.86 for the benchmark. And this dropped their performance since inception down to 4.48% annualized. I'm not sure if y'all remember, but they came and presented back in February, and talking to them, they made the comment that they had changed up how they invest a little bit. They realized that they were a little too risky at the time, so they kind of brought their risk parameters in. And I kind of wish they'd done that a little earlier, but it just, you know, we've already had the underperformance, and now we can't really expect the outperformance from them that we've had in the past because they brought those risk parameters in. So after discussion with Charles and Callan and the rest of the staff, we think that it's time to initiate a search and see what else is out there if we can find a better manager for that spot.
So we have a recommendation from the staff now to initiate a search to replace Gifford, Bally Gifford,
Yes, and to accept the watch list.
and to accept the watch list. I'll combine those. Do I have a motion to do that? Accept the watch list and initiate a search.
Motion. Second.
We have a motion and a second. Any further discussion? All those in favor say aye.
Aye.
Those opposed? There being none, item number 2 has include the watch list and initiate the search.
Thank you, sir.
Thank you.
We're ready now for item number 3. You would, Charles?
Item number 3 is TA Realty Fund. I'm going to have Jason Clark, which is head of our private markets, come up and deliver remarks on this.
Thank you. Good afternoon. This is a recommendation to invest. You'll see the bundle, your packet, the information in your bundle. With TA, we have an established relationship with a proven track record of successful funds. This recommendation for Fund 14 will allow for a 5th consecutive partnership between TA and PERS, dating back to Fund 10 commitment in 2012. Of the 4 value funds Mississippi PERS has invested with TA, all 4 have an IRR, internal rate of return of over 10%, with the latest Fund 13 over 16. So they are probably our highest performing value real estate partnership. Fund 14 expects to have a heavy sector allocation to industrial and residential, where growth is anticipated to remain strongest over the midterm. With the inclusion of data centers in Fund 14, TA hopes to enhance the internal rate of return with the expertise of the TA data group. That's a group that they have brought in to utilize their expertise. From a geographic standpoint, Fund 14 will focus on high growth regions along the coast and in the South, where GDP and population growth is expected to sustain demand and rental rate increases. In line with the most recent pacing study done for PERS of Mississippi and along with Callan, the recommendation is for a $75 million commitment to stay in line with the current 15% value target within real estate. Based on 10-year stability and their success in managing unique value real estate funds. Staff recommends a $75 million commitment to be approved to the TA Value Add Real Estate Fund 14.
You've heard the recommendation and the reasoning from staff for this $75 million commitment. Any further discussion of the board? Questions? May I have a motion that we approve this recommendation?
So vote.
Have a motion
Second.
and a second. Any further discussion? Being none, all those in favor say aye. Aye. Those opposed? There being none, $75 million commitment to TA Value Realty is approved.
Thank you, sir.
Now we go on to number 4, I believe, Tier 5 DC investment lineup.
In the packet that you have there, you have a short memo from me. I don't necessarily need to go through all this. Basically, what we're requesting is that for the new Tier 5 investment option for the DC portion of it, we're asking that the investment options be made to where they're congruent with what's currently offered in our MDC plan. And the reason for that is you know, it's going to reduce mainly, in my opinion, confusion between investment options because those individuals that are going to be using Tier 5 are also going to be able to use the MDC for additional options. And to reduce confusion in selection there, and also to help us maintain the ability to keep fees, investment manager costs as low as possible, we're requesting that we make the two programs investment lineups the same. So that's, unless there's any questions, and I'm happy to entertain, you know, because we kind of went through this ad nauseum and you know, in meetings, you know, about Tier 5. But if there's any questions, you know, concerning why, I'm happy to entertain them. Otherwise, I'm asking for this board's approval that we include the new DC portion for PERS to be the same as MDC.
Be to empower, is that what you're saying?
Yes.
I'd make a motion to approve.
Got a motion to approve, second?
Second.
Got a motion and a second? Who made that second? Okay. We got a motion and a second. Any further discussion? All those in favor say aye. Aye. Those opposed? There being none, Tier 5 DC investment lineup as recommended by staff has been approved.
Thank you,
So
sir.
we'll take that. Now, I do have one comment outside of this. I didn't want to confuse this issue.
Sure.
I must say, and I'm going to say it this time, the meeting that the board allowed us to attend out in Seattle was very good because it touched on some of the fiduciary responsibilities of a board in a DC plan. And also it touched on the expectation that's coming out of White House and federal executive orders and that sort of thing. And it had to do with the concept of offering in the flexibility of a DC plan, crypto investment. Now, I had some discussion with our in-house attorney while we were out there. So can you just bring us up to date, maybe what the status of that would be and whether the state law allows that, whether our basket would allow that, just a little bit about where we may be going or maybe looking as far as that sort of investment.
Currently, we offer a brokerage option in the MDC plan, which will be also offered for Tier 5. Currently, we don't offer the ability to buy ETFs, but that's something that's in works to allow as we go forward. So as far as crypto investing goes, I as a chief investment officer, I'm not willing to endorse any crypto investing yet. But what I can tell you is that there's an ETF for that. And if participants want to invest in crypto, they will eventually be able to get access to it through the brokerage option.
Okay, I'm not advocating that by any stretch of the I just want us to be aware that that's on the national picture and, is being looked at the federal level for allowance and I don't know what legislation or if that would even be necessary, but just to know that that was discussed at the meeting, and it talked about, and I think the word, y'all correct me if I was wrong, basically they said you were not a good fiduciary if you didn't allow people to spend their money there or invest their money there. Now that's kind of what I heard, but I don't hear very well, so maybe there was something that's a little bit different. But it's on the horizon. Just be aware. That's all I wanted to do is bring it to a horizon.
Thank you, sir.
Okay, that takes us to action item number 5, the and U.S. growth search.
This is to tag along with the discussion that we had concerning the watch list. This is basically looking for your approval for the search criteria that we will be using for our search to potentially replace Valley Gifford. And unless there's any questions, it's standard, procedure that we follow for all of our searches. So unless there's any questions, I just asking for your approval of these search criteria.
Okay, so we did approve the search for Bailey Gifford along with the watch list. This is just the criteria. Any questions about the search criteria as you have reviewed it? Got a motion?
Second.
And a second. Further discussion? There being none, all in favor of the growth search criteria, say aye.
Aye.
Those opposed? And the growth search criteria is approved.
Thank you, sir. The next item is our real estate, public real estate investment managers, our REIT managers to present.
And lunches are ready, if this would be a good time to break, if you agree.
I think this would be an excellent time to break for lunch, but
Sure.
can we aim for 45 minutes at lunch?
30.
Do what?
About 30.
How about 30 minutes? Well, as a practice school lunch eating 15 minutes, 30 is a good time for me. Let's aim for 30 minutes then. We'll take 30 minutes for lunch and begin back at 12:30, Charles.
Which means we'll be at 12:40.
Do what?
Well, that'll put us on about 12:45.
We're gonna aim for 12:30, 12:40. Okay, that's about it.
Yes, sir.
Okay?
All right, thank you.
So if we get to lunch, and
Sounds good.
be good.
All right. Sure could.
We're sorry, your conference is ending now. Please hang up.
We're ready to resume the investment committee meeting. We're moving on to item 6, the REIT manager presentations.
Mr. Chairman, we're about to hear presentations from our two public real estate managers, and Jason's here to give you a quick overview of who they are.
Thank you. As you probably know, REITs are our most liquid aspect of the real estate portfolio. They are linked to the public markets, so they actually trade on the open market and are very liquid, unlike most of our real estate and private market program. The target allocation for REITs is 15% of the real estate portfolio split evenly between two managers. Currently, the REIT allocation, it sits just over 11%, and we are working to fix that, to bring that back up to 15. Our two managers today are Center Square, which is our U.S. strategy, the domestic strategy, and Cohen & Steers, which is our global strategy. But even being a global fund, a global REIT, 60% of it is domestic. So it just goes to show you it doesn't have to be all international. A few details for the year ending June 25th, the portfolio posted for Center Square, a 12.28 net return, outperforming the benchmark by 234 basis points. Over the 3 and 5 year periods ending in June, 25, the portfolio outperformed the benchmark by 84 and 60 basis points respectively. For Cohen & Steers, for the year ending June 2025, the portfolio posted a 3.45 net return, underperforming the benchmark by 154 basis points. But over the 3 year period ending June, the portfolio also underperformed by 13 basis points. But over the 5 year, the 5 year outperformed by 12 basis points. And since inception, or since we gained the partnership with Cohen & Steers in 2010, the portfolio has outperformed the benchmark by 49 basis points. Today we'll meet with Center Square will be Scott McGuire and Dean Frankel. And with Cohen & Steers, it'll be Michael Nolan and Ji Zhang.
Wait a minute, say that last name again.
Ji Zhang.
Ji Zhang.
It's J-I is the first name, Z-A-N-G.
Ji Zhang.
Yes, sir.
And it was Todd or Scott?
Scott McGuire.
Very good.
I think you'll be impressed by Ji. She is, we talk on a quarterly basis for update calls, and I can't AI ChatGPT a question she can't answer. I've tried. She's good.
Okay. Well, very good. Let's bring Center Square in then.
Yes, sir.
Mr. Chairman, another thing that you should have learned in Seattle, that's where the term Skid Row came from.
Really?
Whenever they cut those timbers down, and they would skid them down the side of the mountain into the river to transport them, the people that worked in the lumber mills lived on one side of where they went down, and the people that owned the lumber mills on the other. And they referred to the people that worked in this Skid Row, and that's where the term came from.
Could be with us today. we do have your materials, in front of us, so who's gonna begin?
I think we know it's Scott, but thank you for
Scott?
having us today.
Well, great. Well, thank you. We were fortunate enough being at the beginning of the alphabet. Our biggest competitor is right behind us in the alphabet, so we spent an hour and a half cheerleading for rates. So we're ready.
Yeah, okay.
Good afternoon. My name is Scott McGuire. I'm the head of, Global Head of Real Estate Security Solutions. Joining me today is Dean Frankel. Dean is Head of Real Estate Securities, also the portfolio manager for the specific mandate. What we want to do today is really touch upon a number of things. I'm going to pass it to Dean. He's going to talk about performance drivers over the last year. We're going to talk about that macro environment, really how we're kind of combating that. We'll talk about portfolio positioning, and we'll finish up with valuation and outlook for the asset class. So with that, I'll turn it over to Dean.
I'm going to start on page 9 and just go through drivers over the past year performance. Just to walk you through this, it shows you the different sectors, and then it shows your average weight, ending weight, and total return for the portfolio versus the average weight, ending weight, and total return for the benchmark. And then the far right is an attribution section, which has sector, stock, and total. As you can see, down in the gray, light gray at the bottom of the right side, we did 49 basis points in sector. We added 167 basis points in stock, and then all in added 231 basis points total over the 1 year period ending June 30th. Sector selection benefited most from healthcare, 21 basis points. We've been overweight healthcare for a while. In addition, we had nice pops from industrial, 11 basis points in data centers as well. And then our only real big loser here was specialty underperformed. But as you can see, there's a bunch of little adds that add up, and all those little things add up to much more too. Moving to stock selection, where we did 167 basis points. Again, what you'll notice is there's two negatives or three negatives here, but only two that are significant in all. But there's a lot of positives here, and that's the key for us, to have a lot of positive stock selection. The best sectors from a stock selection was healthcare, and again, we did 76 basis points in healthcare. That's an extreme amount, but it had to do with a lot of different stocks. It wasn't any one call. There were several different stocks in here, and that's what you'll find from us. Generally, it's broad-based. Usually we do. And then shopping centers, the next sector we did really well with in our B shopping centers, adding 50 basis points significantly, and then office 33 basis points. And the only real detractor there that was industrial, 21 basis points, and that was mostly impacted by being overweight cold storage. That helps. I'm going to just talk to you a little bit about what we see in the world right now. Probably nothing different, and unfortunately, I have a CFA after my name. I do not have a PhD, so I'm not going to tell you what job growth is going to be or all the economic bells and whistles. What I will tell you is there's a lot of uncertainty right now. And as we manage the portfolio, we have to deal with that uncertainty. When you're managing money, especially for institutions, you always want to try to protect our clients against something. This uncertainty, by the way, has been around, honestly, since COVID. It's been this way year in and year out. It's probably a little more extreme right now because if you were to ask me what will interest rates be in a year and a half, I think they could be higher or they could be lower. If you were to ask me the economy, I think, we could be in a recession, but we'd also be a much better economy too. I could see reasons for pent-up demand and for us to be growing back. So we have to deal with this kind of environment right now where it can go kind of anywhere, which in reality, by the way, it can go anywhere. It always is that case, but now everyone kind of feels that way. So we're in that situation. So what we do is we try to have a balanced portfolio. And then one more thing, impact from AI. We still don't know the impact from AI. We see the data center and the positives from that. We see a bunch of jobs coming from AI. But on the other side, there might be jobs losses from AI. And we have to consider that and the implications on that long term as well. So these are all things that we need to consider. And again, what that means is balanced portfolio. Our goal is, if things are bad, we want to outperform. If things are good, we want to outperform. And there's ways we do that. We try to have a portfolio. We like to say, we call it our team on the field. That's all of ours, different stock selections. We like to have our team on the field. We like them to win if it's good, and we like them to win if it's bad. And that's our goal always in this environment. So, kind of give you an example of what we're doing into that. We're overweight, undervalued, either undervalued risk or especially undervalued perceived risk. And the biggest example and our largest overweight in the portfolio right now is shopping centers. So if you think of shopping centers, there's a ton of demand in shopping centers, has been in the last several years. We were most likely over-retailed, way overbuilt 20-something years ago. We haven't added much to the retail stock in 20 years, and we just have continued population growth. We especially like the Sun Belt, and we like the Southwest, and we also like the Midwest as well, especially because that is where you're getting more population growth. You're getting all this population growth, and you're not getting much supply. So you have a really strong supply-demand imbalance there, and because there's not much supply, it makes it obviously even better. The stocks have sold off because of concerns over some of the tenants. Those tenants are very small, yet the growth of this group is very strong, meaning the growing NOI is roughly 3 to 4% per year, cash flow a little bit more than that, which is good. And there's just not a lot of downside risk. If the economy weakens, they'll end up being defensive. It'll be a little less growth, but it'll still be some growth. If the economy gets better, it'll be a little bit better. So you have a nice opportunity there where you're something that's a little more defensive, but is priced at a nice deep discount right now and has a good, what I call supply-demand imbalance. Two other sectors were especially overweight, for example, that fit into this realm would be hotels and office. Again, two other sectors were not nearly as overweight either, and we're both just a little bit overweight, both of them, but they're both sectors also that have almost no supply. So we happen to like the supply. Demand, though, is in question. And there are two sectors that don't do well if we hit a recession. But I would argue we have a very low levered portfolio by owning this company called Host Hotels and Resorts, the largest company. They have almost no leverage. And so ultimately they can withstand almost anything. They traded close to 11 cap. I haven't seen a hotel trade at 11 cap since the Russian oil crisis over 20 years ago. So a lot of value there. And so we do is you own a lot of value and they're priced for risk. At the same time, we're underweight sectors that they're not expensive because none of the core sectors are expensive, and you'll hear that in a minute, but they're fairly priced, but there's actually just as much risk, economic risk there too. So we're underweight. Industrial is one example of that. Industrial happens to be one sector that has a lot of supply. Malls is another sector. We do not dislike malls. Malls are really good. They're fine. And there's no supply of them either. But again, much more discretionary spending versus the shopping centers, which are not discretionary spending. And then apartments as well. And we like apartments too, but again, there's probably not a lot of upside right now in either. So that's what we're doing in the portfolio. Other things, overweight, secular demographic trends. An example of a demographic trend is senior housing and healthcare in general. Healthcare is our largest overweight. By being overweight, senior housing, which is good, but also where you have demographic trends working. Again, not much supply, but demand is going to work because of those demographic tailwinds. Same thing with data centers from a secular standpoint right now, also working too. And one area we're underweight is net lease. We don't dislike net lease. There's nothing wrong with it. It's actually very defensive. It will do great if there's a recession. The problem is the binary outcome. If the recession does great, if there's inflation, it does terribly. And to us, that's 50-50. We don't do 50-50. We want to have a better opportunity to outperform than underperform. Real quick, I will touch on any questions on any of that. Bring any sectors home to roost. Valuation, most sectors are pretty cheap right now, especially all the core sectors are really cheap versus the private market cap rates. On average, they run about 100 basis points at a higher cap rate than the private market values trades, meaning they're cheaper because the higher cap rates work inversely. That means they're about 15% on average on an unlevered basis cheap, and about 20% if you include leverage in that. If you guys follow Odyssey at all, their cap rates are ridiculous. REITs are at least 150 basis points or 200 basis points below those, but those cap rates are fantasy. Next, I'll touch on outlook. As we think about REITs, what's the best time to invest in REITs? Generally, what I have found over our time looking back is when supply is low. Supply is what generally has ruined the party in real estate over time. It has not historically been demand, although there have been times, but has not been demand. It's generally been the supply that's been the problem. Today, if we look out right now, we're still getting deliveries of two sectors, industrial and apartments, and then another data centers. Data centers is its own animal. We all understand what's probably going on. There's a lot of demand there and potential, so we understand why that. The good news on the industrial apartment side is supply is subsiding. I don't know that we'll get a pocket next year, but it is subsiding a lot, and that way it'll be weaker. The rest of the sectors have almost no supply at all. And demand is always questionable. You never know what demand's going to give you. You may think you know, but you never really know what demand's going to give you. And ultimately, we could see a situation where this low supply ends up being, even if we have a little bit of weak economy now, we might get a better growth in the future. What ends up happening is, generally is, the REITs do really well when you need to replace. So all of those core sectors I told you that are really cheap, they generally will end up getting expensive if we need to replace. And then as development, construction pipelines start to build again, which takes about a year and a half to build, then often is what you'll see is then they'll sell off ahead of that after they've gotten that extra growth. So right now, I think REITs look a really good time, and that was probably the best kind of view I have of that.
Okay.
Yeah, one question, you might have mentioned it, the investment regarding malls versus strip malls. Did you, is that good, bad, or what?
I think both sectors are very good, malls and shopping centers.
But we got less malls in the United States than we've had. The number goes down, so that's still a good investment?
I think malls are still a good investment. I think malls are good. We have to pick our spots. So to derive a portfolio, we want to have a portfolio that, again, I told you, if we hit a recession, I want to do well. And malls won't do as well if we hit a recession because you got more discretionary spending. So I could own shopping centers, which are a lot cheaper right now, and concerns over a few tenants that really aren't very big. And I can own them at a much higher cap rate or a much lower valuation, so to speak. And I think I can get in that. The other thing is, if you look at rents, and if you talk to tenants, if you hear from tenants, they pay half the rent in the shopping centers they do the mall. It's a big number. So we, by owning this Midwest and Sunbelt shopping center portfolio we generally own, is they have half the rents of the coastal shopping center guys that we're underweight. And so we're talking $15 rent versus $30 rents, or $20 versus $40 for inline shops. You've got great sales in this and great growth in these other areas. So what's happening is the stocks that we own that have cheaper valuations actually have better rent spreads. They're getting better rents moving up over time. And so that's good too. So we don't like malls. Retail in general, there's very little supply and there's strong demand. There are two issues we have with malls. And again, I think malls are a good investment right now. But the two issues we have with malls are, number one, we don't want the discretionary because if they're not cheap enough. I can own hotels at 11 cap rate that everyone's afraid of because of a recession. And they'll probably give me a 40% return if we don't get this recession and we get on the other side of this. Malls might go up 5 or 10%, but I'd rather get the 40%. And I don't think I have a lot of downside because people are worried about the hotels already, and they've been mispriced for over a year and a half now, by the way.
Well, three of us on this board live in a little town that's going to invest a lot of money in a strip mall, and I'm a little nervous about it.
It depends, in this town or in what town?
Next door.
I don't know what the population growth specifically is in an area, but strip malls have done pretty well. So, but the thing is, there's not a lot of supply.
Glad to hear that.
Most of these companies that we're looking at are not developing much, and they're in big, huge MSAs, and there's a lot of people. So again, I don't know the exact supply demand dynamics of individual specific markets per se.
That was just a side question.
Yeah, and that matters a lot. I think malls will be good. The other problem I have, the other issue with malls is that malls will continue. I don't believe in department stores. I don't understand why department stores will still exist. It doesn't make a lot of sense to me. They don't offer a good value, really, at the end of the day. And so I don't understand how they're gonna end up driving traffic over time. They don't pay a lot of rent, so it's not a big deal, but what it's gonna do is cause disruption. So if a department store moves out, now you gotta move your tenants around, spend money to move your tenants around to keep them, get the same rents, and then you gotta find an alternate use. The good news is generally the assets have value to them because they're generally in very good locations. So as long as you're talking about good malls. So again, not a disliker, but we definitely like the shopping center. We just think it offers a much better risk reward, so to speak.
Thank you.
So the performance attribution that you show is the 1-year snapshot showing where you've added value.
Mm-hmm.
You've added value in the last quarter despite the fact that the returns were negative. Can you talk about your attribution in the most recent quarter and what helped, what hurt?
Sure. We actually, last year we had a 306 basis points, and this year, Dave, I think we're up a few basis points, but it's not a lot. So last year was a really strong year, and I think one of the differences that occurred, early in the year, we were overweight hotels and office, like I mentioned, and underweight malls, and industrial. And malls and industrial went up even though people were afraid of a recession. They went up in the first quarter. And then when April 3rd hit, as soon as April 3rd, of course, those two went down, and hotels were actually the best performer, which is interesting. The second April 3rd hit, when everyone at their most scared point. And the reason is because people looked at the valuation and realized this is insane. And that's why those stocks kind of rallied. So we got back what we gave up in the first quarter, I think, ultimately is what happened there, just on that. The difficulty this year is, and maybe it's a good thing because you probably don't like volatility as much, but we actually like more volatility. If you just close your eyes and don't worry about it because it's not real, you know, this stuff just when stuff moves 5-10%, the sectors or the REIT market, we're able to adjust more and shift more, and gives us opportunity to exploit that volatility on your behalf, and that's our goal. When I like to say when shrapnel is flying around, you know, I put a bib on and it's time to dine for the clients and try to make money for you. That's our goal. So I think we've had less volatility with these maybe 2 to 3% moves. That's all we've had this year. Really, it has not been that big. So it's been a little bit more difficult to want to shift. So we've had a lot less turnover, if that makes sense to you.
Thank you.
Good question.
You mentioned on page 25 of your materials there that a constrained supply, that you insinuated there that tariffs on the raw materials are going to increase prices, or the construction costs. Are you seeing any of that coming to fruition at this time?
We have seen a significant spike in construction costs, and we actually look at what's happened to construction costs versus some of the returns of the REITs over time since, for example, COVID. There's been a big rise in everything in construction costs. So we do follow this. I think recently, if anything, we've probably seen, I think, a little bit of the other side where things have come back down off the highs. The biggest problem with construction costs has been labor. And not just the labor, actual plain labor costs, but what the GCs are making. They were making a lot of money. There's so much getting developed and being built. They're so busy all the time that they're charging extra. They want to make extra profit in. So I think that's been the biggest thing. But yes, we've seen materials kind of rise. I don't know what's going to happen over the next few years. I mean, our construction's slowing right now, right? You're seeing housing construction slowing. China's slowing considerably too. You know, you'll hear from Cohen's here in a minute. They'll talk international. You know, I'm actually a global head. I follow. It's supply's low everywhere. I mean, even in Japan office, there's not a lot of supply. So supply is low globally. So I don't see why all these raw materials and things will go up, but I don't know. Could be currency. I mean, currencies could be. It's not. It's hard to forecast that kind of stuff. There could be, you know, I think people are more concerned about supply shocks. Now we're seeing tariffs, right? You're seeing tariffs, you're seeing on copper, right? Things too. So there's tariffs, there's different things that could impact that supply costs.
Well,
but demand doesn't seem like one of them. I'm sorry.
Yeah, your forecast, it said could generate 8 to 13%. Well, these other factors could, the word could seems larger to me than the rest of the type here, print. So
I didn't write it. Uma probably did, and she might have a PhD.
I'm still on page 25.
I think it relates to this relates to the uncertainty though. And so what I would argue that word could is up there as word because it's uncertain. I mean, on one side you have tariffs, and I'd be happy to look at it. Exactly the words.
Is you saying here?
Well, that's a whole different thing. I mean, I'll talk about total return expectations. What we talked about was low supply. I think REITs look attractive. We look at bond yields and we look at dividend yields, and ultimately, as we're thinking about return expectations, because that is my call. What we think the return is going to be, and ultimately, you're just looking at pulling back some of that discount to NAV. We think interest rates. I think interest rates will be a little bit lower and then probably move higher potentially. There's potential for them to move higher after that. And so that's kind of how we think about it from our total return standpoint too. I think right now we got about a 3% lead quarter to date, so we're probably partially the way there too. But you've got another 4% or 4.5% in dividends, so you know maybe it's 5% more total return. All that will do would be pulling back some of the discount, some of those core sectors as we get through the next year, because as I said, every core sector is discounted by something like 15 to 20% versus the private market, depending on unlevered or levered. And that has to do with the market's fear of the economy and their concerns. So that is kind of built into REIT prices right now. Our expectation is over the next year, while we might not feel certainty, I think we'll be through enough of this where we'll feel less, I guess, less uncertain. Is that the word? Not more certainty, but less uncertain, or less fear. And so I like when fear is already built into things. The biggest problem is when you have something that's doing well, everyone loves it. Like maybe some of the software companies, out there, I was reading last night how the software companies, other than the few that are in AI, are down a ton this year, and there's worry over their businesses. That is the most concerned kind of things I have when something feels really good and everyone loves it, and then all of a sudden it goes from that to uh-oh. So when you get things with a lot of fear built in, there's a lot less that can go wrong because it's already priced in, if that makes sense.
Well, it kind of goes back to your mall concept. You've got a great capital outlay. You've got to have an anchor store. Who's more in danger with the changing buying, tendencies of going online than traditional anchor department stores, which you just mentioned? Whereas with the shopping centers, they're their own anchor, and it may be a Dollar General that's in the middle, but it's seemingly where the traffic is, plus the capital outlay versus the rent return is the sweet spot.
And then, so that's the thing, it's a higher rent, it's the capital outlay, it's all that. By the way, they build some. And so one of the public companies builds things. We actually have our private side has, I think, the second or third largest owner.
Acquirers.
Non-anchored, strip centers. So we own like the little $7 million of transaction, working hard, and mostly in the Sun Belt, by the way, and we love it. And it's because you don't have these big anchor tenants that don't really pay rent. And today, I don't know how you could build something without the anchor having to pay some rent, because it's very expensive to build today. So I think you're right. I think there's kind of more of a risk to that. But at the end of the day, though, with some of these older centers, like the companies that we own in the REIT portfolio that have, I don't want to say old, they're not old, they've actually lightened and brightened them up. If they lose their anchor, okay, they're getting $7, $10 a foot in the anchor, they're getting $25 a foot on the new space. They just break it down. They spend a lot of money, but they don't have to do that 100 times over. And so I think, to me, it is more attractive. So we generally like the shopping center side space, but I don't think you might not want the anchor, is my point. Just you want the haircut or you want the pizza place. People need to go get that all the time.
Other questions?
Dean, you have, it shows the highest allocation sector-wise in healthcare. Can you break that down a little bit?
Yeah.
With the hospitals, outpatient?
Do not like hospitals, and there's probably a lot of concern for hospitals right now. Budgets are going that way. It's not pretty there, but we do love senior housing. Senior housing has a just incredible tailwind coming of demand. We don't know how much more people will choose, like what the percentage of people that will choose to go to senior housing is. You don't know that number, but it doesn't. You don't need an increase. It could even be a decrease, and those numbers could be really big. And there's very little supply. And the reason there's little supply was because pretty much everyone who built that stuff, got crushed in the last cycle. They were building it ahead of 19, right before COVID. And so they're just working out of their problems right now. So on top of really good fundamentals right now going on for the senior housing, they've been able to acquire assets at incredible prices. I mean, they're buying at like 7 cap rates, but at 7 cap rates they know there's at least 25%, NOI growth coming in the next year and a half. So it sounds good. Now, what I will tell you is that is going to go away because there's not many private operators that haven't had to recapitalize at this point, and everyone's trying to get their money into it. And so we're going to see a shift, and those cap rates will come down, and it will become more of a risk opportunity. So we love senior housing. We are also overweight skilled nursing facilities right now. Skilled nursing facilities were crushed for years, and it's both a combination of problems on the cost side because they have a low margin businesses, or their tenants are the operators, and they have a low margin business, and their tenants were getting crushed with just higher costs for people. At the same time, on the revenue side, they were getting very low reimbursements. They finally got a little bit of a catch up on reimbursements last year, and just already kicked in, and next year it's going to be a little bit better to cover some of this inflation. So they should be in a good spot right now. There are still concerns out there, I assure you, though. There's always concern in the space. For example, there's Medicaid cuts. There are states that have some issues. I think it was West Virginia we're concerned about right now. I call him Healthcare Boy, one of my top analysts, and he sends me out what state I got to worry about today, and who's got exposure. So there's constant worries in the space, but it's attractive. They're also buying things at very juicy cap rates as well. They buy things at 9.5% or 10% cap rates. So that sounds juicy. People like to hear that, so the stocks tend to work when that happens. So we do like skilled nursing facilities. We're underweight life science, but we really like medical office buildings, especially high quality medical office buildings. And if you look, I think they're changing the law or the rule on the reimbursements for whether it's on-site hospital, whether they used to give you more money if you were at an on-site hospital, but if you're at a medical office building, you'd get less money. But now I think they're kind of making it be site neutral, which will be a benefit to the medical office buildings, but be a detriment to the hospitals, so to speak. There's a lot of things in healthcare that are complicated and come out, and I'm constantly following up with Healthcare Boy every time he sends me emails and information. So that's kind of the mix of it too. Life science, the demand side's picking up, which is good. It's just too much supply. I think they doubled supply in the 4 major markets. It was just that much. So it'll just take a little while, but its demand is improving. That's helpful.
Other questions? I want to thank you, gentlemen, for coming and sharing with us today. Continue the good work and buy the right properties. Okay.
We'll do our best. Thank you for having us. I appreciate it.
Thank you.
Good job.
This day, and we do have your materials in front of us, so if you'll just point out where you are as you're talking, we'll follow along with that. And to whom should I turn it over to begin?
I'll start, and I'll introduce first Ji Zhang, who is one of the senior portfolio managers. So I'm responsible for one of the people on the team who's responsible for managing your portfolio. And I'm Mike Nolan. I'm the client relationship manager working with PERS in Mississippi. And I'll just start by saying, I was noticing we're just coming up to our 15th year anniversary with serving PERS. So I want to say thank you very much for the trust you've given us over the years, and I think you've seen the strong performance we've delivered. We can kind of talk a little bit about that, about the team that's delivered it, and maybe more succinctly, how we're viewing markets today, and how we're positioned for performance. So if I turn to, or ask you to turn to page 2, just a quick background on Cohen & Steers. We are a public company set up in 1986, designed really to manage portfolios like yours. So I manage portfolios of REITs for institutional retail clients. As of June 30th, you can see our assets under management just shy of $89 billion. And out of that $89 billion, it's about $57 billion are in REITs. So REITs still make up the largest portion of the assets we manage. The two founders of the company are still involved, so Bob Steers and Marty Cohen are still the largest shareholders. I think between the two of them own somewhere around 45% of the shares of the company. Marty is still chairman of the board, and Bob is executive chairman, so still kind of very much involved in the business. I think from our perspective, performance, as you've seen in your portfolio, has been good, and that's thankfully has been true for most of the strategies that we manage. And it really comes down to people like G and the team that she works with, and I'll point you to page 4. We've got just a little bit of an org chart showing, this is the team that manages your portfolio. So it's headed up by John Che, who is our president and CIO, and John's been with the company for 20 years. He was appointed, actually he started off as an analyst on the REITs team, was promoted to portfolio manager, then to co-head and finally head of the REITs business. And he was promoted to our chief investment officer about 6 years ago in 2019. And then the promotion to president just happened in the beginning of this year. So he as president works side by side with our CEO, Joe Harvey, who's been with the firm for about 30 years. The team right below John, of which G is a part, our head of listed real estate is Jason Yablon, who's been with the team. And without going through all the people here, I'll just say that we have one of the largest teams of portfolio managers and analysts. We think that's hugely important because it gives G and her colleagues who are the portfolio managers the ability to kind of see everything that the analysts are doing, make sure they're building and managing portfolios correctly and generating the returns that they've been generating. And then we have people in New York, which is our largest office, in London for our European, Middle Eastern investments, and then in Hong Kong for Asian, the Asian companies that we cover. And we just think it's important to have people locally because we are investing in, for your portfolio, in companies around the world. And maybe with that, it's kind of a transition to G, ask her to talk about recent performance, our outlook, and kind of how we're positioned. And we're happy to take questions along the way or at the end as you like.
Great, thank you all. So I'm going to start on page 5 to touch on how your portfolio has performed, what are some of the big ideas, but also tie in a little bit what's been happening in the market. So page 5, clearly year to date, the portfolio has performed well, up about 8% on an absolute basis, outperforming the benchmark by just under 200 basis points so far. And if you look at the next page, in terms of the contributors and detractors, and I know there's a lot of names, there's a lot of words here, but ultimately it's about just as much about some of the big themes that we got right, but also some of the things that we avoided, right? So what are some of the things that we got right? In the US, it's been some of the secular growth stories. Digital realty has been a huge beneficiary of AI data centers as a data center operator and owner, and they have been able to capitalize on the spending and the CapEx that we have seen over the last number of years. Another similar story along the theme of secular trends, but different, is Welltower, a senior housing owner operator that is really benefiting from this current demand, current demographic environment where there's a lot of baby boomers that are getting older. There's not enough supply because it, as an industry, has struggled tremendously during COVID. Supply is down a lot. So they're able to grow occupancy. They're able to have pricing power. They're able to find really good acquisitions. So those are some of the top holdings in our portfolio. But at the same time, Alexandria, life science owner operator, top of their industry, really good historically, but we have been zero weight, and that's been a huge contributor to our performance because it's a great sector that is going through a tough time, right? There's been a lot of supply that was built during COVID because everyone thought there was going to be all of this healthcare and kind of innovation that was going to happen, and a lot of real estate was built in response, and now we're seeing markets with 20, 30, 40% new supply. VC funding has pulled back tremendously, and now they have the added headwind of potential NIH funding cuts. So it's a good sector long-term that's going through a really tough time. We made the right call by being underweight. Similarly, industrial is another sector that over time people have really liked it. and it's performed very well over time. We have been very, very underweight because it's another sector that is going through some challenges. People built a lot of warehouses during COVID, and they have pulled back. There's a lot of trade uncertainty, so port-related markets with import-export activity are being impacted. Retailers have no idea how to plan their supply chain right now. So as you can imagine, they're not making decisions. They're not signing leases. So industrial is another one of those sectors that over a 10, 15, 20-year period, probably a really good sector. But it's been one of the more challenging sectors year to date, and we have been right by avoiding some of those more port-related markets. And then outside of the US, one of the big calls that we had made was adding to Hong Kong. It's a country that we have been underweight for almost a decade. And we started adding to it towards the end of last year because it got really, really cheap. And we saw that things were starting to bottom. And even though we can't predict what the level of China's stimulus was going to be, we added to it because of the valuation signals and because we thought that things were starting to go the other way. And it has been one of the big contributors. So those are just some of the quick ideas for, the quick contributors to our performance this year. Moving on to slide 8, just a high level kind of outlook in terms of the global markets, what's been happening year to date. So on this chart, the first column is the second quarter, the second column is year to date. So I'll focus on the year to date and tie that into what's been happening in recent years. So the two things I would make is when we think about a global portfolio, diversification is becoming increasingly important. We're seeing economies that are at different parts of the countries that are at different parts of the economic cycle, different parts of the monetary cycle. So we're seeing a lot more zigzagging where Europe has been cutting, the US is about to cut, but on the other hand, Japan is coming out the other way and they're actually increasing rates, but their economy is doing really well. So year to date, Europe and Asia have outperformed the US by a big amount after years and years of underperformance. So some of it is because they're under-owned. They got really, really cheap after years of underperformance, but part of it is because the ECB is cutting, part of it because China is stimulating, so that there is some fundamental support for those economies. And I think the other trend that's really important when we kind of look at the outperformance for Europe and Asia is I do think it's a potential precursor to what we could see in the US. Right? Europe has outperformed because the ECB has been cutting. And we do generally have an expectation that the Fed will start cutting more aggressively over the next 12 to 18 months. And that generally is a supportive environment for REITs. So I do think that's a leading indicator. And we have been telling you all for a long time that when we're seeing a rate cutting cycle, REITs can start to do well. We're starting to see a little bit of that rotation from tech and broader equities to some of these markets that have been interest rate sensitive and have underperformed the broader market. We're starting to see more interest, more flows. And I think this is a good example looking at what's happened in Europe as sort of a good precursor to what we think could happen in the US over the next 12 to 18 months. From a fundamental standpoint, let's turn to page 10. So there's 3 things we're focused on today right now. One is macro, one is fundamentals, and one is valuation as we think about the outlook for REITs over the next 12 to 18 months. Of those 3, admittedly, the one that I'm most excited about today is fundamentals. Macro, I think it's getting more interesting because I do think that we're getting closer to the Fed cutting, and valuations have been interesting for a long time and I think continues to be relatively compelling. So on fundamentals, the most important story here is supply. We always say REITs is an inflation hedge, but then people will say, well, why haven't REITs done well when inflation has been up, right? And part of the problem is it takes a little bit of time. It takes a little bit of time for construction costs to be high. It takes a little bit of time for financing costs to be high before we see supply come down. So if you look at the supply picture, and this is on page 14, it is coming down, finally, after years and years of overbuilding. New starts in 2024 is down on average 50-60%. So that means deliveries in 2025, 2026 is going to be down 50 to 60%. So if you think about the macro setup right now, things are slowing, right? We're seeing slowing job growth, we're seeing slowing wage growth, but offsetting that is supply that is down 50-60%. So unless we think we're going into a severe recession, which is not our base case. Our base case is that we're going to see slower growth, slower job growth, slower wage growth. That significant decline in supply is what's going to give REIT pricing power, and it's going to give REITs the ability to grow at a rate above inflation. There's your inflation hedge, but 12 to 18 months, 24-month delay because of that timing lag from when you start a new construction to when you deliver that. So fundamentals are good, even in a slowing environment. And the second part is the macro I talked about. And generally what we see is if you're seeing slower growth and you're seeing lower rates, that's actually the perfect setup for REITs, where you're not chasing the cyclical stuff because economic growth is really good because that's slowing. There's a little bit of rotation, but at the same time, you have defensive recurring cash flows that can grow at a rate above inflation. That's a good setup for REITs. And we got a day of it on Friday when the market got really excited about the Fed cutting rates. But I do think as we think about the Fed, whether they're going to cut 1 or 2 times this year, they're going to cut, a couple of times next year. Generally, that is going to lift some of the headwind for REITs over the last couple of years. And lastly, on valuation, I would say we are really interesting and really cheap versus equities because unfortunately REITs have lagged equities for the last couple of years. And we're also interesting versus private real estate. So if you look at page 20, REITs tend to outperform when they get cheap. Seems like a very obvious comment. And we have been cheap for a while. But usually when we see this level of valuation discount, and today we're trading at a 5-turn discount on multiple versus equities, when we look at the 1-year, 2-year forward returns, that generally does lead to significant outperformance relative to equities. So when you couple that with what I said earlier about the macro and the Fed potentially cutting rates and fundamentals being pretty good, those 3 things, when you put them together, it's a pretty good setup. And also versus private real estate. We have a comparison here as well on page 22. And I know you all look at REITs versus private real estate and think about that comparison. Now, one thing I think is really important to call out is that when you look at the REIT market, right, I talked about data centers, I talked about senior housing. We also really like single family for rent. These are areas of the public market, the REIT market, that is quite different from the type of exposures you get in private market, right? Private market, there's office, there's retail, there's apartment, there's industrial. A lot of these core real estate sectors that some of them are struggling today. So there's more growth from these secular growth opportunities, but even when you compare the core sectors side by side, which is what we're doing here. For example, if you look at this chart on the left-hand side, we're comparing what the REITs are trading at today. For example, in industrial, we're looking at the implied cap rate for Prologis, for some of the pure industrial REITs, and we're comparing that to the marks for the Odyssey funds. There's 100 to 200 basis point gaps between the industrial names in the REIT market versus the marks that you're seeing in the private market. So here, higher implied cap rate means it's cheaper, right? So across every core asset class, REITs, the pure plays in the REIT markets are 100 to 200 basis points cheaper than what you otherwise would be able to get in the private market. So what does that mean? That means in Europe, we're seeing more M&A. We're seeing companies, industrial companies get taken out. In Canada, we're seeing residential companies get taken out. We had 2 M&As just last week within the REIT market. So the private capital is taking advantage of some of these discounts, but also public investors are seeing these discounts, and to the extent they can, they're trying to reallocate some of their capital that is trading at a 4 or 5 cap and trying to look for opportunities in the public market because there's a clear arbitrage to the extent you can execute on that. So very different types of exposure. I think there's better growth and more interesting next gen, what we call next gen markets in the public sectors in the public market. There's a big valuation discount, and we do think that there's a catalyst for some of these valuation discounts to narrow versus equities and also versus private real estate. I'm just going to wrap up very quickly on page 25 in terms of our positioning, some of the changes we made in the portfolio. We talked about data centers already. We talked about senior housing already. In Asia, Hong Kong retail is a sector that we have been positive on because China is stimulating and China is directly stimulating their consumption. And some of those Chinese consumers are going to Hong Kong to spend. We're also very positive on Australian home builders because unlike the US where we have 30-year mortgages locked in, they have 3 to 5 year mortgages, which means they're seeing that quicker mark to market. And by the way, Bank of Australia is cutting, so that is leading to a much faster recovery in their housing market versus our housing market. And in Europe, I think the big theme there is continued M&A because we have some names that are trading at 15, 20, 25% discounts in net asset value. We're seeing the large private equity funds form 5, 10, $15 billion funds. So I do think that to the extent we see names that are still trading at really big discounts in Europe, there's going to be more M&A. There's going to be more activity that's going to actively narrow that discount. So with that, I'm happy to take a pause and see if there's any questions.
Okay, questions?
I have one that may not even be relative. 3 members of this board are from an area of our state that 20 years ago, the furniture industry was a big business and growing industry to the point that we were rivaling North Carolina. And because of foreign influx of furniture, they have just about dried up. Our president has just put a big tariff on incoming furniture in an effort to revive the furniture industry in the United States. Is that relative at all? Will it not drive up the price of the product to the point that sales will go down because of what has happened?
Yeah, so that's a really topical question. We spent quite a bit of time looking at that. So the good thing is that when you think about the REIT market overall relative to the broader equities market, we're actually fortunate in that we're quite protected from the margin pressures and the potential impact to consumption as a result of the tariffs. There's a couple areas that we are focused on when we're looking at the REIT market. One is home builders, which is actually not directly in our benchmark, and we don't own any today. So for the home builders, to the extent they're thinking about their supply chain, there is going to be an impact and higher cost to their supply chain because of the tariffs. And that's been one of the concerns and why we have not owned any home builders today in combination with the fact that mortgage rates are still really high. And then other areas that we are focused on is industrial is an area that is more directly impacted by the changes in the supply chain and what's happening from a tariff standpoint. Again, less of a direct impact to warehouses, but more how does it impact a decision-making for the furniture retailers in terms of how they need to think about their business model and where they're going to source that from. Where they're going to bring furniture from is going to change potentially depending on what the tariff situation looks like. So that's leading to a lot of indecision. So we're not seeing retailers close warehouse to open new ones because they actually just don't really know right now what it's going to look like and what the tariff situation ultimately settle out. So we're seeing lower leasing activity because retailers are in a wait and see mode to see ultimately, do they want to bring in their furniture from Europe? Do they want to bring it in from China? Is Vietnam still a viable option, or do they think about Mexico? So there's a little bit of indecision that's still happening, but no direct REIT impact. And by the way, when we think about the REIT market, typically less than 10% of their business comes from new builds, comes from developments. The majority of their income is from existing buildings like this, where they're collecting the rent on the office building. And so they're a little bit more immune from the cost of construction going up. If anything, like that supply chart, they actually benefit from it to the extent others aren't building and there's less competition for them.
Is the furniture market still relevant in North Mississippi?
Not as much as it was, but we still have a fairly significant amount of furniture that is being made there. What's the name of that?
Ashley is the largest. Ashley is the largest furniture
Is Futoran
manufacturer.
still in business? Futoran?
No.
Actually, that's a great point, George, in terms of how we think about just onshoring demand in general and how that could impact economies. So when you think about some of our portfolio positionings, we have moved more towards markets that we think could see more reshoring, onshoring activity as a result of the manufacturing that is going to be brought back to this country. So if you look at our industrial holdings, for example, very much focused on the Sun Belt, but also increasingly looking at where we can get exposure to the Midwest. And we have narrowed, and we are very cautious on port-related activity as a result, because we do think that there's going to be a rejiggering of demand and economic growth activity over the next number of years.
Yes, sir.
In the gaming space, you have some United States investment. I don't know if some of the other positions do. Do you see any impact of the move to online gaming affecting your brick and mortar investments on the gaming side, whether that's the gaming facility or the attached hotels?
So we do see some impact. So we own Caesars within the gaming space, and the good thing for Caesars is that they are actually growing their online platform as well, in addition to their brick and mortar footprint. I do think that over the long term, regional gaming could have some structural headwinds as a result of online gaming. And it is a good source of tax revenue for the states that are open to it. But right now, the licensing is still very spotty depending on the state you're talking about. Not every state allows online gaming. So when we look at the portfolio, the regional gaming operators, the brick and mortars, are much more protected in those states that have historically been less prone to approve online gaming licenses. But for us, our holding is more bifurcated in the sense that we would prefer the gaming operators like Caesar that can benefit from both. And online gaming for Caesar also help them add to their ecosystem, right? If you're an online user for Caesars, they're much more likely when they go to Las Vegas to go to a Caesars casino, because they have certain benefits, they have certain loyalty points. So it actually does sort of help their ecosystem by having both.
Thank you.
I'm interested in the digital, whatever it is they call that. How large of facilities are we talking to build? I mean, how big are those buildings that's going to take all of this power?
Yeah, the data centers are massive and getting bigger. Just to give you a little bit of a perspective, when I was covering data centers, 10 to 15 years ago, we used to get really excited about a 10, 20 megawatt lease. And now we're talking about 100 megawatt to 1 to 2 gigawatt leases. Just to put that in context, in Northern Virginia, if you're thinking about call it 50 to 100 megawatt data center, that's enough to power all of the houses in all of Northern Virginia in just one data center facility. So obviously it's a huge demand on power that's why we're out of power in a lot of places. And that's also why there's been more and more pushback on data center developments in certain places. And the line for data centers is getting longer and longer. I think the good thing is that when we think about the REIT market and our exposure data center realty, they're generally being quite thoughtful about the innovations around renewable power. And I do think that that's why there's more bipartisan support for nuclear power over the long term, if done safely, because it is draining the power availability across many countries, and we are seeing more cases of power shortages. So the utility companies are being quite thoughtful in how they're allocating power to the data center company and how that could potentially impact the residents. But at the same time, they're trying to figure out ways to increase capacity, because of course, we do think that AI innovation is really important for this country, and it's going to be a really important growth driver. So I would say that a lot of utility companies are working in conjunction with their government to try to figure out how to bring this innovation in a way that's not going to be impactful to the residents' power resiliency.
So are y'all involved at all with the construction and of the nuclear sites that are needed in this portfolio?
We are not.
Okay.
We are not.
I think Curios, Google, and TVA are working currently on, it's probably 200 meg generation to facilitate data centers in Tennessee and Alabama, and TVA is committed to buy 50 meg from them to help with the cash flow. And the state of Mississippi has had $26 billion worth of data center announcements in 3 projects in the last 24 months. So we are very interested in that. The first project was a gig of power that was needed, but I think it's a potential growth sector for the state as far as investment, but it does have a utility need from water and energy, but you know, we're hopefully on the cutting edge.
Is our power grid gonna keep up with this investment?
That's a good question. The capacity is one thing, transmission is a second issue, and that's why the modular nuclear being able to be built near the facility doesn't require the transmission. That would be the second issue. We could generate the power, but if the highway's full on the transmission lines, we can't transmit it. So that's why the modular nuclear is probably the way they're going to go. And I think 2030 was when they were hoping that that would be deliverable. And it's huge regulatory burdens with anything nuclear. And of course, Grand Gulf was the last thing built here that was what I would call the old school reactor style. But we're definitely, as a state, have pursued that, and you know, have to pursue the power and utilities that go with it.
Be sure and tell them that we got electricity in part of the town of Clinton, so we'd like to have some of those investments.
Well, and that's one of the big things, whether you're talking about water or you're talking about electricity, your residential customers often have preferential status and treatment as far as weighting. And of course, a lot of the people that are investing are capitalizing on green energy credits, which is why they're willing, as someone coming to invest in the state, to actually invest in the generation of power because they're benefiting on the back end.
And for the most part, my understanding is most of the tech companies are doing that directly and negotiating directly with the utility companies. And I think that is a preferred route for the utility companies as well, because you have the Amazon, the Microsoft credit, and they have the balance sheet to commit to that.
Other questions from board members? Others? Well, I want to say thank you for the work that you've done. Continue to do the good work and keep the returns high. Okay. Y'all have a great day here. Thank you so much.
Thank you very much.
Waiting on Bill. When Bill returns, we'll be going on to item number 7, miscellaneous updates, when he gets here shortly. Anything else you need to add about these global REIT managers?
Other than they're both exceptional managers.
Very good.
Which book is it, this next one coming out of?
I think it's just a document.
What do you have today? Just a reminder, you're gonna make me a little, notation of the things that were done today,
Absolutely.
so that I can modify it.
We threw that on.
Absolutely. Yes, sir.
I appreciate that so much. Okay, well, let's go ahead.
Okay.
We'll go ahead with.
Last item, miscellaneous updates. PGIM, they are going to be combining their public and private credit teams, not impacting what they do for us. And then Aero Street, which is one of our quant managers, Tony Ryan is going to be retiring from his position of chief executive officer. Again, nothing to do directly with our investment management for our portfolio. And then LSV, which is one of our global asset managers, they're a global value equity manager. They're going through a little bit of litigation with some of their former employees. I don't have an opinion on this. This is just me letting you know it's happening. And then the last item is just some ancillary income, information on PERS and how we performed for the 1 through 20-year periods of time against all the major peer groups that Callan follows. And as you can see, we pretty much dominate in all of the periods and all of the universes. So that is all I have. And unless there's any questions, I would like to close.
Okay, that completes then the investment committee, all
Yes,
that
sir.
you have. So, prior to my adjourning that committee, do you have anything, Mr. Director, that you need to talk in this particular area
No,
other
sir.
than tomorrow?
That's right. No, sir. Not unless there's anything that you or others would like me to discuss. We'll just be back tomorrow at 10 a.m.
Okay, and all of the regulation changes that will go into effect or be talked about tomorrow has been addressed in some ways in the plan. You know, it's just changes to make sure it's with the law. So as you read and peruse those, just know that. But other than that, the investment committee is adjourned.
Sir.